controlled and there are media guidelines. On the other hand, there is a commercial press in China and also an internet sphere where people engage quite freely in many cases on certain topics. But there is also an active censoriate. So it's not the same as having free and open press. And moreover, China is controlling its messaging overseas very carefully through a network of state-controlled, party-controlled media outlets. So we are talking about carefully crafted messaging.
An unfair question, but how do you see a resolution of this mess? How do you believe China will respond? And not the bizarreness, but just the chaotic sense of it in Washington. How will they respond to that?
I think the Chinese entrepreneurs are having a difficult time with this. I think the ByteDance that started TikTok, the entrepreneur there had really tried to make TikTok a non-Chinese company, but the fact is the home company is in China, and countries around the world are very concerned about data management and data privacy, and that's just not something that the Chinese have been able to persuade people that they can protect.
Thank you so much for joining us. Carla Freeman there of Johns Hopkins, and be sure to check out VRUS Go on the Bloomberg for the latest information. And you can, of course, tune in every day for our exclusive conversation with Johns Hopkins experts for an inside look at battling COVID-19. Now, coming up later, Bill Gates, Microsoft co-founder. There will be a conversation on vaccines and COVID-19. That's at 6:30 p.m. in New York, at 11:30 p.m. in London, and this is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
When everything around us, including the way we work and live, has been interrupted, uninterrupted service is peace of mind. Juzi from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
This is Bloomberg Surveillance. I'm Ritika Gupta. Let's get the Bloomberg First Word News. President Trump is turning up the heat on congressional negotiators. He says he may take executive action to stop evictions and to enact a payroll tax holiday. Republicans and Democrats say they have made some progress in negotiations on a new stimulus package, but they're still far apart on key issues. China's next target in the growing tensions with the U.S. could be American journalists in Hong Kong. That's according to the editor-in-chief of China's Global Times, who's become known for accurately predicting rejecting Beijing's actions. He says that if Chinese journalists are forced to leave the U.S., China will retaliate against American reporters in Hong Kong. And Spain's former king is leaving his homeland in disgrace. Juan Carlos I says he plans to leave the country he ruled for almost 4 decades. He helped lead Spain to democracy, but a series of scandals have tainted his standing amongst Spaniards. In a letter to his current king, his son, Juan Carlos, said he would move outside of Spain, but didn't say where. And regulators are looking into a small group of investors who got rich when the price of oil took an unprecedented drop. It happened on April 20th when oil settled at minus $37. It was the first time crude had ever crossed into negative territory. Bloomberg's learned that traders at a tiny firm called Vega Capital London made as much as $500 million that day. Regulators in the UK and the US are trying to see if any rules were broken. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine, Tom.
Ritika, thanks so much. Greatly appreciated. Craig Moffett, Michael Nathanson, always smart on streaming, on entertainment, on content, and the distribution of that content. Joining us now, supposedly on Disney's earnings, although we're not going there, is Michael Nathanson, founding partner, senior research analyst. Michael, you have a sidecar skill of looking at some of these new technologies like Snap and the rest of them. Is TikTok a valid platform to raise revenues, whomever buys it?
Yep. Morning, Tom. I think it is. You know, the engagement is there. It's you know, what we've seen in traffic this year has been incredible, right? It's really risen in terms of time spent and usage. So I think it can monetize, and that will change. You know, if it's owned by Microsoft, it's going to change the dynamic of this industry.
Even when Instagram was taken out, and folks, Sarah Fryer of Bloomberg owns a high ground on this in her wonderful book on Mr. Systrom and Instagram. But Michael Nathanson, is this somewhat equivalent to Instagram, where we all underestimated what Facebook would do with Instagram? Are we doing the same thing here?
Oh, without a doubt, Tom. Even a couple of years ago, they started, bringing in stories, Instagram stories, and I myself, had doubts whether or not they can monetize stories because it's just a different format, different consumption pattern. But they've done it really well, right? So where there's engagement on mobile phones, there's monetization. That's just what we've learned. So, yep, I think that's right. I think it's a really good analogy.
Michael, how does Snapchat do it, though? And actually, who does Snapchat take eyeballs away from?
I mean, with TikTok, no. So our view is, at this point, because we're such a strange time when people are out of school, people working from home, it looks like all boats have risen. But we think over time, logically, if TikTok keeps doing well, it's going to hurt Snap and Instagram, right? It's a similar demo, and you would think over time it's going to hurt them on consumption and on advertising. That there's going to be a new competitor taking ad dollars away from those two bigger companies.
Is this the deal of a lifetime for Microsoft, or the deal of a decade?
It depends on the price, right? It depends on the price. As Tom noted about Instagram, Facebook pays our little for Instagram. It depends on the price, but you know what? It's interesting to me that they want to get into this business, right? Because they really not show much interest in a consumer business like this. So it kind of, to us, it really questions like where do they want to go with this, and what do they see? So you know what? It's a deal of a decade in terms of a change of strategy, I think.
Craig from Manhattan emails in and says, ask him a question about Disney. Let's go there, Michael. On Walt Disney, it was trading at 110, streaming revenue moonshot to 150, and down we go. It's what we call, folks, a red zone, green zone chart. Michael Nathanson, does Disney have the ability to get up into the green zone, $150 per share?
Tom, we downgraded Disney back in early May, so my answer would be no. Not for the near term, right? Just the headwinds in their legacy businesses and parks and movies and live sports and cable networks. There's so much pressure pushing those businesses the wrong way. Yes, they've got a great streaming story at Disney Plus. That's great news, but where they make money, where they really drive cash flow, there's so many headwinds. So it's we thought it was going to take some time. In fact, I've been surprised how resilient Disney's been during this crisis, because in previous downturns, the stock would have been hit much harder, and it hasn't been.
Michael, I loved when you were in that episode in season 2 of Succession. James Murdoch walks away from News Corp, Mr. Murdoch, the son of Rupert, and there's the whole family tension and all that. Great. How does News Corp fare? Not so much without James Murdoch, but just as the generation passes on, what's your update on News Corp as an entity?
Okay, so we don't cover News Corp.
I know,
I'm quite familiar with it. There's this interesting dynamic in News Corp. They own the Wall Street Journal. If you look at where the New York Times has moved to in terms of its enterprise value, embedded in News Corp is the Wall Street Journal. And I would think that the company would start focusing on maybe cleaning up. They have a lot of disparate assets there. And, given, again, what we're paying for the New York Times and that narrative, I would think News Corp has to look at its asset base and start trying to figure out what can they do to jettison assets that are not that relevant anymore, right? And it worked for Fox, right? So we would come on and talk about Fox for all those years, and Fox started to work because Rupert decided to break the company up and sell it to Disney, and it doubled in a year. And I think News Corp, the question for me is how motivated are they to kind of clean up the asset base and focus in on the Wall Street Journal and Dow Jones to get investors to pay more attention to it.
Michael, if you were to, put in a snapshot exactly what COVID-19 does for a lot of media and telecoms, does it just accelerate a trend that was already there, or does it make them change course?
Yeah, it does both. What we've found and we've written about is, over our career, we've seen these types of crises really accelerate trends, but also break patterns that you thought were wobbly. So, this time around, cord cutting is going to accelerate. The decline of linear entertainment viewing will accelerate. Advertising may not come back to legacy TV the way that it has in the past. So it's going to force. It's made Netflix a king because of it, but it's going to force all the companies to deal with that, right? And many of them, unlike Disney, were not ready for this transition, so they're going to have to catch up and spend more money. And I don't know if they have the will to do it, because it's really expensive to compete in streaming. So to me, this has been a terrible outcome for the legacy media industry. Just terrible, because it just made Netflix and digital so much stronger so quickly that I'm really quite down on kind of the long-term future of a lot of our companies here.
All right, Michael, thank you so much. Michael Nathanson there, MoffettNathanson, founding partner and senior research analyst, joining us this morning. Up next, Carla Harris, Morgan Stanley Global Wealth Management Vice Chair. We have a lot to talk about her. This is Bloomberg.
market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance. Tom and Francine from London and New York. Now, Diageo shares are slumping after it reported full-year results that missed estimates. The spirits company didn't provide guidance for the following year, while sales at Diageo were hit pretty hard as the pandemic led to the closures of bars and restaurants, with e-commerce and supermarket purchases failing to fill in the gap. Well, we spoke to the chief executive, Ivan Menezes. Here he is.
The two things consumers want most coming out of lockdown and these conditions is meeting up with family and friends and going out to a bar or a restaurant or pub or a festival. So that human motivation, we believe, was going to endure. And as conditions improve, we'll see consumers go right back in. But what we're doing in the meantime, actually, is creating the experiences at home. So one of the trends you've seen is cooking from scratch and baking has picked up. So with Bailey's, we moved right into that space on social media and digital engagement, and we've seen a very good response from markets like China to the United States, where Bailey's is doing better. Johnny Walker, we have a program called Kitchen Sink Drinks, where online we look at what ingredients you have in your fridge at home and design cocktails that you can make at home, because there's a huge desire to get bar quality cocktails at home. To your point on consumption levels, they haven't gone up. In fact, we've seen sequentially per capita consumption come down for a long time. We obviously stand very much for drinking in moderation and drinking sensibly. You have seen the shift from out of home to in-home, but say in a market like the UK, where 40% of the business is out of home, I mean, that has collapsed. The in-home consumption has picked up, but total alcohol has dropped about 20%. So it is not true that the overall populations are drinking more. You are seeing the shift from out of home to in-home. But what we're encouraged by is the trends towards premiumization. We were talking about tequila. Casamigos, Don Julio, these are $50 bottles of tequila, are growing double-digit right now. So we're seeing that trend also sustain, particularly in the United States.
Well, and it's your margins. It's your margins, I know, Ivan, that investors have really appreciated. And I wonder if they can expect a boost in revenue with those big margins to really help in the second half or in fiscal 2021. I mean, you're seeing, I assume, a comeback in places like China as a precursor to what you expect in the Western world. So can you tell us from that what kind of quality you expect in a sales recovery?
Yeah, so what we're looking at, our last quarter was the weakest quarter because it had the biggest impact of the lockdowns around the world. We are seeing sequential improvement. Even in the last quarter, month to month, it improved. And as we look forward the next couple of quarters, we're expecting things to get better each quarter. To your point, in China, every day, every week is getting better. The on-premise is reopening, and we're seeing consumption pick up in the on-trade. The same happens in like the UK, where the pubs have opened a few weeks ago. We are seeing steady recovery. Footfall is at about 70% of normal. The beer business in the first couple of weeks was 70% of normal. But we expect that to improve. But clearly, it is based on the conditions of the virus and government policies also that will impact it. But overall, across the world, we do expect sequential improvement for Diageo.
Well, that was the Diageo Chief Executive Officer Ivan Menezes speaking to Bloomberg this morning. This is what the markets are looking at. So stocks are actually edging down here in Europe. Futures also taking a turn for the worst. There was a concern about some poor earnings, and that illustrated the continuing hit from the coronavirus. If you look at Bayer, it was down after downgrading its sales outlook. BP also cut its dividend. Its shares jumped after, though, the company reported a smaller than expected loss. Now, turning to the most important topic of diversity. At 22 years old, Lauren Simmons became the youngest ever woman to trade at the New York Stock Exchange in 2017. She was also the second black woman to ever hold such a spot. Now, the entrepreneur and former equity trader at Rosenblatt Securities told Bloomberg that recruitment on Wall Street needs to change.
Wall Street has definitely established themselves as a goal to want to achieve, but I do think the lack of diversity over decades, anything past 2000 anything is unfortunate, and I do think that we will see a lot of, especially Gen Zers, just creating their own firms, and they're going to make diversity and inclusion a top priority.
Well, that was former New York Stock Exchange trader Lauren Simmons, and Simmons' story is featured in a special edition of Bloomberg Markets magazine focused on diversity and shares the stories of black men and women on Wall Street. Well, let's get straight to Shonali Bajak, who contributed to the issue. Shonali, I mean, we're talking a lot about it, but are Wall Street firms actually recruiting differently? Are we going to see a meaningful change because of this?
We're definitely trying to. Remember, a lot of these firms had been known to recruit from many Ivy League universities. The question is, will they start to span out away from that? And what will the educational institutions also be fighting back so that that elite status stays with them? The idea is to go beyond that and try to recruit elsewhere. And you heard from Lauren Simmons, younger people are looking to vote with their feet, so it could mean a real talent drain from Wall Street in the future if there isn't further movement.
Shonali, thank you so much. Shonali Bajak there with some great reporting. Now, coming up later today, Bill Gates, Microsoft co-founder. Don't miss that conversation on COVID-19 and vaccines. That's 6:30 p.m. in New York, 11:30 p.m. in London, and this is Bloomberg.
As it stands right now, we are seeing too many people, for whatever reason, attending work with symptoms. That just cannot continue. Otherwise, these restrictions will be in place for longer than they should be. And I'm sorry to say, we will see more people die.
When community transmission takes place, it is inevitable that it will find its way into the more vulnerable parts of our community, and the aged care community is certainly one of those.
Certainly, these are very challenging numbers. We're at a very challenging stage with this wave. There's probably not a country in the world that has gone through a second wave that hasn't found it particularly challenging. It has very different and complex elements to it that make it quite difficult to manage.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
Hi, I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Remember, the U.S. economy is still doing better than most other economies in the world.
The bifurcation between the asset side of the economy and the real side of the economy is accentuated at very low yields.
The global economy is healing, but there's no vigor to that economic recovery. And we probably won't get that vigor until there's a vaccine.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on Bloomberg TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Tom Keene, finally, some signs of pressure reaching lawmakers down in Washington, D.C.
You're right in cue. There's no question about it, John. It's on schedule here 1, 2, 3 days into the ballet. Many people looking out to the jobs report this Friday as being the real catalyst. Either way for a discussion here, but yes, and the president impatient.
And the Texan Republican Senator Cornyn impatient as well. Lisa, these words stand out for me. I can't see how we can go home and tell people we failed. They will all have to go home at the end of the week if there isn't a deal and tell them we failed.
And there's added pressure from President Trump saying if you guys don't do it, I'll go about it unilaterally. Unclear what he can do unilaterally. At the same time, his support for the $600 plan, you have to think, is adding some pressure to passing this through by Republicans. Today, talks do continue with Republicans Mnuchin and Meadows, with Pelosi and Schumer on the Democratic side. We're going to be watching for that. Also today, what I'm looking at, 10 a.m., U.S. June factory and durable goods orders. This follows yesterday's better than expected ISM reading that showed a manufacturing gauge of factory orders the strongest since September 2018. And aftermarket today, Disney reports earnings expected to have a loss, but John, everyone looking at Disney Plus, how much traction they're getting with their streaming. You know, did you order Disney Plus just to watch Hamilton, John?
Of course I did not do that over the last couple of weeks.
This is my shocked face.
Will anyone ask Disney, Tom, whether they will buy TikTok? Will anyone else come into this battle for TikTok in the next couple of weeks?
Glad you mentioned it. We just had on Michael Nathanson and did a lot of good talk about TikTok. John, let's put it this way. Disney has $14 billion in cash. Microsoft has $140 billion in cash. You do the math.
Yeah, I think Microsoft has the money to get it done. Did you see the line that came from the Chinese media in the last 24 hours? Let me read it to you because the irony here won't be lost on anyone. China will by no means accept the theft of a Chinese technology company, and there's plenty of ways to respond if the administration carries out its plan, smash and grab. Last week, the tech CEOs were asked by one lawmaker whether they believe that the Chinese steal U.S. technology. Apple, of course, with a presence in China, hands off. I don't believe we're aware of any first-hand experience. Mark Zuckerberg at the gate, Tom Keene, what did he say? Congressman, I think it's well documented that the Chinese steal from U.S. companies. And that is the irony of this moment, Tom.
John, and I know we got to get to Michael Purvis, but I think it is so important, as you mentioned, Mr. Zuckerberg, to mention his commitment not to Beijing or to Washington, but to New York. His taking of the full office space across from Penn Station is arguably the greatest statement on this island of Manhattan since 9/11. It is unbelievable, the commitment of Facebook to that office space. It's very exciting for Manhattan.
He is on a big PR push, that's for sure. We'll catch up with Kevin Cerulean in around about 15 minutes. Looking forward to that conversation. Right now, though, we've got to bring in the bull of the moment, Michael Purvis, Tallback and Capital Advisors CEO. Michael, I'm just going to call you Mr. 3650 on the S&P year end. How are we getting there?
Well, I think more of the same. My framework, really since this extraordinary measures by the Fed, has been to, not look at valuation on the S&P 500 on an absolute basis, but really the only way I can look at it right now is on a relative basis. In other words, I look at the forward earnings yield, the inverse of the price earnings ratio, and subtract the 10-year Treasury yield. And when I see that spread, it gives me enough comfort to get to 3,500, 3,600, 3,700 by the end of the year, even without an uptick in earnings estimates. I guess that's all a fancy way of saying the Fed is forcing you up the risk curve into buying equities there. But let's not forget, John, that the big cap tech companies have a long history of demonstrating not just high earnings growth, but also a consistency of that earnings growth too. And they're such a dominant part of the S&P 500 right now that I think it's really kind of more of the same here. There's a huge footnote to this argument, which is that if bond yields are to start rising higher, when I'm talking bond yields, I'm talking 10-year Treasury yields, if we start seeing those go up through 1%, 1.25%, this framework falls apart real fast. So this valuation or this price target is really predicated upon the continuance of a super suppressed bond yield.
And Michael, that's right where I wanted to go. And that, okay, it's a great bullish call. There's other people out there with the same tone as well. It's completely predicated on the inverse PE, inverse cash flow ratio is well. Let's say you're correct and we sustain. Why do you stop at 3,600?
Well, I guess I'm crossing each bridge as I come to it here, but I think for the last several years I've had this very this view that in this world of very low nominal GDP, as long as there's some GDP growth and these very low interest rates, price earnings ratios could be supported at extraordinarily high levels for a longer period of time, thanks to structural disinflation, aggressive central banking, and all that. So forth. And again, with that added component that you have these big cap tech companies really grinding out this important earnings growth, that has less economic sensitivity than you find in other sectors there. So, I will cross that, what my end of year 2021 target is at some point in the next few months, Tom. But I do think that this framework is really, really important. And I've never seen an equity rally this hated as the one that we've been working with. And the hatred has been high in the last few years. It took up a level in the last few months. What I advise my clients is you have to learn to love the hate, because it is. And I still think there's an argument that there's a lot of cash on the sidelines that will be coming into equities when they see that the returns on treasuries is as minimal as it is.
Learn to love the hate is definitely the mantra for a lot of bulls right now. I do wonder, though, a lot of people saying that bonds and stocks are sending very different messages, especially as we see inflation expectations over a longer term pickup. And your concept is predicated on the idea that the Federal Reserve will continue to go in and buy treasuries increasingly on the long end in order to suppress yields, even if the economy stabilizes and continues to grind higher, providing some sort of support to the earnings that you're talking about. Do you think that is a crucial aspect of your recipe to get to 3,650?
Without question, it's crucial. It's critical. Now, there's massive amounts of uncertainties across the economic, macro, COVID landscape and all that. There's one thing, the most important security in the world is the 10-year Treasury. And what Powell has achieved over the last several months through 150 basis points in cuts and all the other programs of asset building is he's not just sort of capped this 10-year yield at very, very low levels. He's also smothered volatility. If you look at the June FOMC, 14 of the 16 projectors of the doc had zero interest rates through the end of 2022. 14 out of 16. In other words, a huge, it wasn't just a few outliers, 9 to 7. And their GDP and unemployment forecasts are actually more constructive than what Bloomberg consensus had, right? So I think the Fed is sort of saying it without saying it, is that they're becoming a little bit less data dependent. And I think there's a separate conversation as to whether that's healthy for the longer term economy and so forth. But in terms of asking about my 3,650 and beyond, I think it's very clear that that type of sort of overwhelming support and cohesion within the Fed on these policies gives you high certainty that interest rates will be very low. With that one big caveat, Lisa, that if inflation, starts really climbing to a much higher level, and the term premium on 10-year treasuries is yanked up, perhaps by bond yields overseas getting yanked up by what's going on over there, that could be the big wild card.
Hey, Mike,
so you have
Lisa doesn't care about equities. Yesterday, when she was getting really bored and we were having a stock conversation, she pinged me a message and said, watch out for Alphabet. They're issuing debt. And Tom Keene, I have to say, have you seen how that debt priced? When Lisa flagged this yesterday, how this debt priced is unbelievable. 40-year debt, 225, 10-year debt, 1.1%.
Money costs nothing.
Alphabet credit, Tom.
Money costs nothing. I mean, there's just no other way to put it. And John, that puts the M&A boom forward. I mean, you have to believe there will be strategic transactions based on that simple statement, money costs nothing.
Hey, Mike, we've got to let you go. Michael Purvis there, Tallback and Capital Advisors on the equity market, on credit. Lisa, there's been this massive conversation about a 60-40 portfolio. Bank of America have talked about the end of it. And I think the conversation we've had increasingly on these programs is what replaces the 40 portion if you drift away from treasuries? Is it IG, AA, single A rated credit? And if you're looking at the issue in the last 24 hours, the answer might be yes.
Yeah, although you're not picking up very much to go into Alphabet, I will say. I mean, they're pricing very much on top of U.S. Treasuries. What you're hearing, though, from a lot of investment managers is you have to go into riskier asset classes, alternatives, and you have to wonder what the longer-term consequences of this is, right? I mean, it's not just investment-grade credit, because you're getting basically nothing to go into the most credit-worthy names, and that sets it up for all sorts of duration risk. But what are the longer-term consequences, John, of this push into risk?
Well, key phrase is longer term. Tom, 40-year credit, 40 years in a technology company. What was around 40 years ago? In fact, more importantly, what wasn't around 40 years ago in the world of big tech in America?
John, I'm watching TikTok right now.
You look
Hold
very
on.
distracted.
I'm
What
looking,
is that?
I'm looking at TikTok with my...
Is that a Spurs
That's my
mask?
Spurs mask that I got on. Thank you so much for sending that in.
Yesterday we talked about the advantages of radio.
Yeah, radio looks good as well.
Yesterday it was Lisa and today it's you. Can you explain what on earth you just put over your face?
That was a Spurs mask. This is just wonderful.
As in the English Premier League team, your tots.
The tots.
Spurs.
Yes. And I was looking at TikTok while I was doing that because I'm addicted to it. John, 40 years is absolutely what caught me on this stuff. And I'm sorry, it's like lemmings over a cliff, John. It's like the support for the tots. I mean, all it comes down to is everybody's going to do it, John. Everybody's going to do 20-year, 30. I mean, maybe the 40-year is a new 20-year piece.
Nothing you've said subsequently I've heard or understood. I am so confused this morning. From New York City, good morning. Alongside Lisa Brabbitts, I'm Jonathan Ferro.
You can't say
Don't know
that
who
on
this
TikTok.
guy is. Coming up on this program, Francis Donald and Manulife Asset Management from New York. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. President Trump may take executive action if Congress can't agree on a new coronavirus stimulus package. The president told reporters he might impose a moratorium on evictions and enact a payroll tax holiday. The White House is also exploring whether the president can act on his own to extend enhanced unemployment insurance payments. And President Trump insists that if TikTok's U.S. operations are sold, the U.S. government should get a cut. But it's not clear under what authority the president could extract a payout. He said the money would come from China or from an American buyer such as Microsoft. Earlier in the day, the president said TikTok would have to close in the U.S. by September the 15th unless an American company buys it. Hurricane Isaias was downgraded to a tropical storm as it made landfall and moved inland over North Carolina. It's prompted tropical storm warnings all the way to Maine, including Manhattan. Temporary flood barriers and platforms have been deployed in New York City. The storm doesn't pose a threat to any major oil refineries or platforms. And Northern Ireland faces a Brexit food time bomb. Extra paperwork will raise British supermarkets' costs of operating there so much that some may pull out. That's according to the Northern Ireland Retail Consortium. Starting January the 1st, animal products transported from the rest of Britain to Northern Ireland will require export certificates. That could add $52,000 to the cost of each shipment.
And BP has cut its dividend for the first time in a decade. That removes a cornerstone of its investment case after the coronavirus pandemic hammered almost every part of its energy business. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
The fiscal policy actions that have been taken thus far have made a critical difference to families, businesses, and communities across the country. And it will take continued support from both monetary and fiscal policy to achieve that.
The Fed really can't stimulate the economy very much when people don't want to borrow and businesses depressed and so on. What they can do is make sure we don't have a financial calamity on top of the real calamity, which they've been doing very well and will continue to do. We need fiscal support.
It also is a very important step in dealing with inequality. Ultimately, inequality and the institutional biases that are baked into the cake of our economy.
I wouldn't be surprised if we did get the scenario Tom and I were talking about, that the market would just take over and drive interest rates into negative territory, even without the support of the Fed.
You see coming. Some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
The investment bank merger is something we have been discussing actually for months. This is not a cost exercise. There will be some cost benefits, but it's really about having one underwriting business, to have one investment bank globally, one equities business.
We are really getting an understanding of each side's position, and we're making some progress on certain issues, moving closer together. There are a lot of issues that are still outstanding, but I think there is a desire to get something done as soon as we can.
Senate Minority Leader Chuck Schumer there with a word you haven't heard much of, if at all, over the last couple of weeks. Progress. From New York City this morning, good morning. Hoping for progress down in Washington alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. 2 hours away from the cash open in New York. You can add 12 minutes to that. Here's your price action in the equity market in New York City. Equity futures shaping up as follows. This Tuesday morning alongside the bond market and FX as well. Equity futures coming in 11 on the S&P. We're down 1/3 of 1%. The bond market bid, Treasuries firmer, yields lower, down 2 basis points on 10s, back to 0.53%. A little bit of a rebound rebound, and then we track lower again. In the FX market, pretty mixed this morning, Tom, in G10, 117.66. The event risk on the calendar, of course. The talks resume down in Washington later today.
John, the TIPS 10-year yield just went down to new record low. That's all you need to know. There's a real deterioration in bonds. It's nuanced here. We can go through that. But, John, I'm telling you, a 1.0503 negative statistic for the 10-year yields talks about a slowdown in the American economy. We'll get to that in a moment. Right now, Kevin Cirilli, as we heard Senator Schumer, our chief Washington correspondent, Kevin Cirilli, on what will happen today. What will happen today, Kevin, in these better negotiations?
Well, it was a breakthrough yesterday, and we don't know precisely what the breakthrough was. I was trying to figure that out just within the last 12 hours, really, and we don't know what, but it was significant in the shift in tone coming from Senate Minority Leader Chuck Schumer, as well as Speaker Pelosi, who also echoed what Schumer had said yesterday. But I would note that also yesterday, President Trump said if there is no deal, he is willing to use executive action in order to address the certain issues as it relates. So that is almost a dare to leadership in Congress by saying, look, he can go longer if you don't want to get to a deal because he can utilize executive action.
Okay, it sounds like a divorce, Kevin. Not that I know anything about that. Now, Kevin, what I really want to talk about here is they solve the easy things, right? Now they got to figure out who gets the dog. I mean, that's really always the most important thing here. What is that thing that's going to really slow this down? What's the dog in this debate?
Kevin's lost for words. Hey, Kevin, let me help you out. Tom's got some experience here, and he's tortured by it, and he thinks there's a dog involved this time around. Tom, I hate to break it to you, mate, but on this occasion, there's no dog involved.
Based upon my reporting, what I can tell you is that funding for state and local governments, I think, is really what is going to be the issue here and the final price tag. But I think beyond that, I also think that tax credits for small and medium-sized businesses is also going to be an issue that comes to the forefront as well. And then something that centrist Democrats want to sell to their constituents. Yesterday, I spoke with Congressman John Garamendi, a Democrat from California, and I asked him point blank about that, and he noted that and he drew this parallel of if funding for state and local governments does not increase, and there are furloughs for firefighters, furloughs for individuals who work in the sanitation divisions, for example, all of that really could cripple cities right now, which are desperately in dire need and already hurting. And so that, I think, is something that Schumer as well as Speaker Pelosi are really fighting for. And of course, coupled with the liability protections of Leader McConnell, I do think that those three issues are really what's at stake here.
Kevin, whatever happens in November, I do believe this administration will be a case study for decades to come on executive powers. And when you hear the president say things like, he can do this himself, when it comes to TikTok, and he says things like, we're going to take a slice of that, they should give us a slice of that. For a reporter right now down in Washington, how do you take that message? Do you just take the message and repeat it? Or do you start thinking about whether he can actually do those things?
Well, it's a trend. It's a trend in the executive branch that dates back to the Obama administration. And actually, candidate Trump was very critical of former President Obama for his use of executive orders and executive actions. And Republicans, in and of themselves, have been incredibly critical of during the Obama years. And in fact, it was during one of former President Obama's State of the Union addresses, Jonathan, when he noted that he would have the power of the pen, so to speak, in order to go around a dominantly Republican Congress. And so that's where I think it's interesting to see now the tables so significantly turn, where the President Trump is saying just as much. What I find fascinating is the same criticisms as it relates from a foreign policy perspective. However, in the Obama years, it was uses of drones, but now I think the president has adopted a much more economic approach in terms of foreign policy, using that as a preference. But the contrast is striking, but the strategy and the use of executive orders is the same.
Let's make this specific. John was talking about how he's using more executive power. Perhaps he's building on what President Obama did. But can President Trump unilaterally reinstate the $600 of enhanced unemployment benefits and prevent evictions in the short term?
He says yes. He says who's going to stop him. He said, and he will make the case that he ran as an outside candidate who now has assumed a broken Washington, D.C., and that the system of Washington is broken, and that he needed to do this in order to address this because Democrats, he'll argue, stood in his way of negotiations. But Democrats on the Hill, in contrast, will say that he is wanting to be cheap, for lack of a better word, and not wanting to fund in the long run some of these cities. But it's an interesting dynamic, and we spoke about this previously, where when I talked to sources on the president's reelection campaign, Lisa, they really want to have the president talking about the economy and talking about solutions. They still feel that's where he is positioned to do the strongest.
Kevin, in the zeitgeist, there's always those little moments. I saw very quickly a snippet of a video of the senator from South Carolina, Mr. Graham, in Columbia, talking about the CARES Act and about the stimulus, the $600 check, and he looked nervous. What are these guys hearing when they go home?
Well, they're looking at the University of Chicago study, which, of course, says that individuals who are earning more monies on unemployment benefits. But Democrats are looking at a Yale study that says that that's not the case. So they all can pick their data. But in terms of South Carolina, which you could look at in terms of as a battleground zero, so to speak, for trade policy, not just with China for automobiles, but also Europe, Senator Graham has been a political chameleon of sorts, dating back to late Senator McCain and now with President Trump. But he's someone really who is in the mix of foreign policy conservatism and is really in a fight that he's expected to ultimately win. But he's also running, like Leader McConnell, for re-election.
Hey, Kevin, always great to catch up. I always finish my conversations with Kevin now saying run, just in case we get another one in. Kevin, fantastic. Thank you. Bloomberg Chief Washington correspondent. Tom, I'm with you. The Republican Party starting to crack a little bit here. Senator Shelby yesterday, there's pressure on both sides. Senator Cornyn yesterday saying, I can't see how we go home and tell people we failed. That's the reality they face going into the weekend.
You could see it in Senator Graham's face, you know, with all great respect for his public service. John, Catherine Rampell in the Washington Post this morning is brilliant on all those academic studies.
More to come on this. Frances Donald of Manulife Asset Management on the labor market and where she comes down on enhanced unemployment benefits from New York City this morning. Good morning to you all. This is Bloomberg Surveillance Live on Bloomberg TV and Radio.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Some things you see coming. Some things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
From New York City, this is Bloomberg Surveillance for our audience worldwide, live on Bloomberg TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Your price action this Tuesday morning shaping up as follows. Equity futures down 10. On the S&P, we head south. We are negative 1/3%. Really strange FX market in G10 today. The safety of the Swissy outperforming. Then the Aussie is in there as well. Makes sense of that. The euro up by not even a tenth of 117.69. In the bond market, Tom, the curve steeper yesterday, flatter this morning, down 2 basis points on 10s to 0.54%.
I really agree with this, John. I want to sit on this for a while, folks. This cross-asset dynamics is very, very subtle. It's what surveillance was built on. But, John, I totally take your point on the linkage of FX dynamics into yield dynamics. Again, I go to the 10-year tips. But, John, look at the U.S. 10-year, the nominal rate. It's really trying to make a thrust lower this morning.
Just in and around 50 basis points, Tom, but we've been grinding lower over the last several weeks. I think there's a really interesting narrative we need to explore that we've tried to do on this program over the last several weeks. That's this European outperformance story people have started to talk up.
Do you see it?
We haven't seen it yet in the data in a big way. I've seen it in the market. Let's be clear about that. We've seen it in the euro dollar starting to pull out. We haven't seen it in the data in a major way. The reason I say that is because we had the ISM in the last 24 hours in America, Tom, and it was actually pretty decent. And we wake up this morning and Kit Jukes of SocGen and others talking about the possibility of US resilience and maybe people talking down the United States too much too soon.
Yeah, as a proxy, folks, I go there to the 20-year Swiss yield, which is a negative yield, if you can believe that, out 20 years, and it's trying to make a new low to get back and test the March lows. Right now, a woman who knows that all of this market chit-chat folds right into the guesstimate on the American economy. Frances Donald is at Manulife and does wonderful, short, brief messages and research reports on the concept at hand. She's never written on anything like this Friday's jobless report. Frances, how do you approach the complete mystery of this Friday's report?
Well, I'm not trying to get a sense of what that headline is going to look for. I'm looking for a lot of the underlying details. And what I suspect we're going to see is that more people are unemployed on a permanent basis as opposed to temporary. And the duration of unemployment is going to start looking much worse and worse. So while you might see headlines that say we have some moderate improvement, ultimately the underlying foundation of the job market is just getting worse and worse.
There are 3 unemployment rates, the visible one, which everybody is glib about, etc. Chairman Greenspan's lovely augmented unemployment rate, and then the all-in U6 rate, a much higher statistic. Which one matters?
the most all-encompassing. And this is what's been so challenging about COVID-19 and its ensuing recession is that the pain on the economy has been so much more sinister than what we see even in headline GDP numbers. We're talking about wage losses. We're talking about larger levels of income and racial disparities that flow as a result of it. As an economist, we're used to looking at traditional economic data and telling you what happens next, but there's so much more happening under the surface here that's more concerning. And most of all, when we look at the underlying picture, we still have 14 million Americans that have to be rehired just to get us back to February. It's very difficult for us to look at this number and say, even if we see, another 1.5 million people, quote unquote, rehired, we're still in one of the worst, if not the worst labor market we've ever seen. And yet here we are, we're going to probably hear a lot of headlines talking about how there's been improvements on Friday. It just doesn't sit right.
Francis, the challenge for you is you've got to take the data, understand how it's changing, then try and understand how investor attitudes to that data are changing as well. If we got a negative print in the payrolls report this coming Friday, how do you think investors would respond to that?
I think they'd probably view it as a call to action for policy and likely some implication that we're going to see a faster move on fiscal stimulus and maybe some additional moves from Powell. For the last month or so, we've been claiming or trying to highlight that the high-frequency data that told us mid-April was a key positive inflection point is now turning in the other direction. But the key here is not to say the economy is going to worsen and therefore stocks are going to do badly. No, the key here is to say the economy is going to worsen and this is going to engender an important policy response. The game here is no longer econ data. The game is figuring out how Powell and how we're going to see Congress respond to it.
The dominant policy response when it comes to markets has been that of the Federal Reserve monetary policy. And I wonder from a jobs perspective, how much the low interest rate policy that the Fed has, the backstop to the markets, is actually creating jobs, stabilizing jobs, keeping companies from firing people. Can you draw any connection to the Fed's policies to employment in the United States right now?
Over the long run, yes. In the near term, their essential function is to ensure we don't see a credit crisis. That is their main issue at the current moment. They're doing a very good job of that. And that's why the entire focus of the macro sphere has really shifted away from monetary policy, of course, hugely important to the way we're trading anything from rates, gold, a whole variety of asset classes, but towards fiscal. When we look at the City Surprise Index and we see the largest spread between where data came in and economist expectations, I like to call this how wrong economists are. They've been the most wrong they've ever been for this particular measure. What we know, and what's my personal opinion here, is that the thing we missed was just how sizable fiscal stimulus was going to be, how big the numbers were going to be, how we were going to see 2/3 of Americans who'd be making more than they did pre-COVID. Personal income up double digits on an annualized basis relative to last year. If we lose that main pillar of this rebound, then the econ data starts to worsen pretty substantially. And my concern is that as much as we missed how powerful it would be on the upside, we may miss just how painful it will be on the downside.
Francis, I've got to say, I like that. Tom, do you like that we rename the surprise indexes the economist success rate or failure rate?
Yeah,
basically just judging them real time as the data comes in.
John, this has been brutal. I have no idea Friday, folks, what we're going to see. I don't know how I make a 3-month forecast, let alone a 6-month forecast. It's really no different than the companies. But Francis, the heart of the matter here is what you people do, which is count countable things. Can you count the stress in the American economy?
You can count a lot of stresses, but we're not using the same measures we did before. And this is why, honestly, I'm more focused on initial jobless claims this week than I am on non-farm payrolls.
It's countable.
Monthly data is too stale for us. This crisis moved so quickly. So all those alternative niche data points that we're now all talking about every day, the Google mobility, the TSA passengers, how many people are going to restaurants, that data is so much more important. And what we witnessed in the past, since about mid-April, is that movement in the ultra-high frequency daily and weekly indicators are what gets markets' attention. So non-farm payrolls, of course, should be the most important number of the week or the month, but it's not going to be. It's going to be all that mobility data that tells us, are people still moving around? And increasingly, Tom, not just are people moving around and our stores open, but what is their confidence level? Are we realizing reopening economies and people feel confident using them, the demand side of the picture, that's also much more difficult to count. So we absolutely have to move away from those traditional data points and look at new ones. It's very uncomfortable for economists. It means we have to change our models and our forecasting process. But this is COVID-19. We have to do economics differently.
Francis, I can hear the concern in your voice. It's palpable. Can you walk me through the scarring and the structural changes, the structural damage that you're really worried about right now?
What I see ahead is, we have to trade on a, 3-month, 6-month basis as well, but we also have long-term portfolios, and it's the long-term portfolios that I spend a lot more time thinking about, because even though we care about equities in the next 6 months, we're in the midst of the largest fiscal spend outside of wartime. We are beginning to see the seeds of debt monetization. Look at real rates. They are deeply negative and likely to stay there. This is a transition to a new system, one that's probably going to see steeper yield curves. It's going to, probably create some misallocation of capital. It's probably going to push more money into alternative and hard assets. This is the way that COVID-19 actually has these more sinister long-term impacts on the way our system is working. So yes, I could, lay out why the economy will weaken in the next 6 months, but what really keeps me up at night is how we need to think about the 5 to 10 year horizon. That's what's changing very dramatically on a week-to-week basis here. It's going so quickly, and yet it has such long-term implications. That's where the concern you hear in me, John, comes from.
Francis, one thing Tom's been focusing on for the past few days, and rightly so, is the negative real yield in the United States, this increasing inflation expectation longer term, despite the ultra-low yields now. What's your sense of inflation going forward?
So my sense is that we may actually hit a little bit of some concern about stagflation in the second half of the year. Now, I'm not a raging inflation bull. Our models say we get to 2.5% inflation. The market thinks something a little bit under 2. But in the second half of the year, a lot of those base effects are going to drop out on inflation. And I'm sure I'm going to have portfolio managers asking me, have we underappreciated how much inflation is in the system? I also think we need to move away from the idea that monetary policy is the source of inflation, and remember that deglobalization and huge fiscal spends with large fiscal multipliers, that may be where inflation is coming from. So I do expect the market to raise those inflation expectations. I do expect real rates to continue to trend lower, remain negative for a long time, and that is, of course, going to push more money into search for yield opportunities. It is still bullish, yes, gold.
Francis, great to catch up with you. As always, my best to you and yours. Francis Donald there of Manulife Asset Management speaking, Tom, to the importance of claims this Thursday and maybe not the payrolls report this Friday.
Again, there's 3 statistics there. There's claims, folks. There's a 4-week moving average of claims, which not a lot of people talk about. And then this concept of continuing claims. John, what's so important is it's highly countable, but it's also wildly asymmetric in that it just looks at the claims part of the economy. Mike McKee likes that JOLTS survey, which we'll see here in a bit.
Well, think about payrolls and the estimates this coming Friday. And this is not a dig at Bank of America. They've done tremendous work over the last several months. But we had Ethan Harris on this show yesterday, whose estimate Friday, Tom, is $1 million. But he wouldn't be surprised to see a negative print. What does that tell you about how unpredictable this Friday is? Can you imagine the band being that wide every Friday, every first Friday?
It's always unpredictable. The media talks in certitude, and the pros like Francis Donald don't. And the answer is it's wider now than it's ever been.
On the oil market and the energy market as well, up next on this program, Jason Gamble at Jefferies. Looking forward to that conversation, not just on energy, but on big oil, as some of these companies have to cut their dividend and face reality, not for now, but for the next several years. In your market this morning, good morning. It is a stormy one in New York City. At least that's what we're expecting. In the equity market, a sense of calm still, down 14 points on the S&P 500, negative just 0.4%. Outside of equities into the bond market, a little bit firmer. Risk appetite diminished, yields lower, down by a couple of basis points on a 10-year to 0.54%. From New York, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. President Trump is turning up the heat on congressional negotiators. He says he may take executive action to stop evictions and to enact a payroll tax holiday. Republicans and Democrats say they have made some progress in negotiations on a new stimulus package, but they're still far apart on key issues. China's next target in the growing tensions with the U.S. could be American journalists in Hong Kong. That's according to the editor-in-chief of China's Global Times, who's become known for accurately predicting Beijing's actions. He says that if Chinese journalists are forced to leave the US, China will retaliate against American reporters in Hong Kong. And Argentina moved closer to ending a months-long standoff with investors. It says there's a deal backed by the largest creditor groups to restructure $65 billion of debt. That may open the way for one of the world's most notorious borrowers to climb out of its third default in 2 decades. And Spain's former king is leaving his homeland in disgrace. Juan Carlos I says he plans to leave the country he ruled for almost 4 decades. He helped lead Spain to democracy, but a series of scandals have tainted his standing among Spaniards. In a letter to his current king, his son, Juan Carlos, said he would move outside of Spain, but didn't say where. And here in New York, Facebook has signed a lease for all of the office space at the Farley building. That's a former post office in Manhattan's West Side that's been redeveloped by Venado Realty Trust. Facebook will take over 730,000 square feet at the site. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
A sense of the real-time action, the 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
We know it's a pandemic, and we want to be very responsible for pricing. We plan to underprice this vaccine for its value, especially in the pandemic phase.
support right now. We're only halfway back to normal. We need a package that's about half as big as what we got in the spring. So it's got to be like $1.5 trillion.
1.5 trillion, a number we've heard a lot about on this program. Jason Furman mentioning that number as well. There is currently a $2 trillion and change spread between Republicans and Democrats as those talks continue down in Washington. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. That was Ethan Harris of Bank of America. Here's your price action this Tuesday morning. In the equity market, we shape up as follows. We're down 0.4%. We break down in the last 30 minutes or so. We're off by 14 points. No drama after yesterday's big tech-inspired rally. In the FX market, a euro 117.60. Really muted price action here as well. Just your typical summer August Tuesday churn. Yields lower by 2 basis points, 0.54% is your yield. Tom Keene, it feels like one of those stereotypical summer's days, but we know it isn't.
It is not. The news flow is extraordinary, folks. We're going to frame this through surveillance. John's the open here at 9 o'clock as well. I'll do it with Paul Sweeney on Bloomberg Radio here at 9 o'clock. There is Microsoft. There is TikTok. There's all this economic talk. And we've taken our eye off the virus. There's no one better at Bloomberg to speak about this than Max Neeson, who folds in a prodigious knowledge on the healthcare industry with virology. Max, thrilled that you could be with us today. There's no question about this. There's warfare at the White House. The president went after Dr. Birx, and Dr. Fauci defended Dr. Birx. How do you synthesize that into a viral policy of Washington?
I mean, it's as it's been for some time, this public and perceived private disconnect between the president and the people that ostensibly or who should be leading the response. And I think that sort of filters through to policy, where on one hand, you have at least some increased acknowledgement of the gravity of the situation, but also...
Come on, Max,
yeah.
Right now, as we speak, out on Twitter, it is viral, is the president speaking with Jonathan Swan of Axios. He has a chart in his hands of the death dynamics, and he is denying pure statistics. How do the people that you look at every day, how do they move forward with that leadership?
It's tremendously difficult, and what you're referring to is, the president insisting on looking at deaths divided by cases as opposed to deaths divided by population. On the first, because we have so many cases, we look great. On the second, we're doing incredibly poorly given the continued death trajectory. I think the people trying to respond and trying to advocate for kind of a rational, consistent, and enduring effective response to the virus are very, very disturbed by the fact that this leadership, or the lack thereof, and especially going to the next phase where we face some really difficult challenges, opening schools or not, and then if we actually get a vaccine, the tremendously difficult thing of actually rolling it out to millions of people. Having a vaccine doesn't mean having it in arms, and that's something that's going to take an unprecedented federal effort, one that as we've seen, it's difficult, is going to be done in the best or most consistent manner possible.
That's where I wanted to go. President Trump yesterday saying that he expects to have a vaccine possibly as soon as well before the end of the year. That does seem to be the circuit breaker that the market is basically pricing in. When is the most likely estimate at this point, based on the science that we have and the developments out of a lot of the big biopharmaceutical companies, what's the latest time frame that you see as feasible?
It's something that is really, really difficult to predict, and one where you really have to define your terms. And that's something that I don't think the president or the market are really doing. So an emergency approval for a vaccine conceivably could hit that timeline. I don't think it will. And beyond that, I'm certain that well before the end of the year timeline does not mean that we'll have many millions of doses and be able to get them to people to get anywhere near vaccine-induced herd immunity. And again, this is all before we have any sense of exactly how effective these vaccines are. Yeah. These are vaccines that, these early wave, require 2 doses and that may not provide sterilizing immunity, prevent transmission, as well as serious infection, which dramatically increases the logistical difficulties of actually getting to a vaccination level where you can get back to economic normal. So if the market is pricing in, a fall vaccine miracle, I think it's very likely to be disappointed in one of multiple different ways.
Max, the narrative is that the United States has had a much worse virus response than Europe. John's talked about this a lot. Is that accurate?
Oh, absolutely. I don't think there's any way to argue otherwise, based on any number of metrics, and then based on the current trajectory. You're starting to see sort of these glimmers of hope of flattening in viral hotspots, but we've talked a lot about death lags. That's also lag in the other direction. When you start to have a bend in cases from what I'll note is an enormously high peak, one that's much higher than the others, that means that the death rates are going to be elevated significantly for the next month. So the gap with other countries and the continuing proof of the failed response is just going to continue. You can't change that.
Yeah, I'm glad you go here. I got one final question here, and that is of the serial integrity of the cases math. Clearly in Brazil, where cases on a per capita basis have flatlined, they're playing with the numbers. There's no question about that. Are you hinting that in the United States, we don't have good serial correlation on our cases statistics?
The thing that keeps me a little bit more confident in at least the broad number of, the broad statistics, with the caveat that, there have been various gaps in reporting from different states, is that we continue to get these sort of daily state reports that when you aggregate them, you can get at least a pretty reliable picture of the outbreak. That doesn't mean that, you should blindly trust the statistics. There's lots of evidence that we may be undercounting deaths, for example, but I don't think there's some glaring, juking of the stats. That's evident to me, at least.
Hey, Max, great to catch up with you, sir.
Really
Max Neeson of Bloomberg Opinion. Tom, this just feeds into the cross currents around the economic data at the moment.
Yes,
Mistakes made over
strongly
reopening
agree.
just a couple of months ago. You're starting to see that in the data now. And this is the problem. Mistakes made a while ago shows up in the data later. Are we making mistakes now, or are we course correcting?
Well, I think we're course correcting is the way I would put it. I would defer to the pros on that, John. But what I would say is you really wonder how all this science talk folds into aggregate demand, the greater economy. And the answer is you never know until years later. We've got to wait out 2, 3, 4, 5 years before we can really begin to look at those interdependencies.
Sometimes I sit here and I do a tease to the next hour and say we're really looking forward to catching up with whoever it might be. And this time, I really, really mean it. So you'll have to work out when I don't mean it. But this time, I really, really mean it. I'm looking forward to catching up with Jeff Yu of White Melon. He's fantastic. He's better than okay.
He's okay.
In this market, ahead of the opening bell, around about 90 minutes away, call it 95, your equity market's shaping up as follows. With equity futures right now, near the lows of the session, down around about 15 points, call it 14. We're off by 0.4%. From New York City this morning, heard on Bloomberg Radio, seen on Bloomberg TV, this is Bloomberg Surveillance.
has been interrupted. Uninterrupted service is peace of mind. Juzi from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
You have to remember the U.S. economy is still doing better than most other economies in the world.
The bifurcation between the asset side of the economy and the real side of the economy is accentuated at very low yields.
The global economy is healing, but there's no vigor to that economic recovery. And we probably won't get that vigor until there's a vaccine.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Thrilled you're with us in news flow. Absolutely extraordinary as the hurricane, tropical storm now, I should say, moves up the eastern seaboard. We welcome all of you on Bloomberg Radio, Bloomberg Television, to a news flow that's simply a cacophony. There's no other way to put it. John, in the last hour, we really focused on the stimulus. In this hour, John, we've got to focus on the fact I downloaded TikTok this morning.
Did you actually download it? What was the first video?
The first video was unspeakable English. Certainly on Bloomberg Radio it would be inappropriate, but what the real issue is, John, the second, third, and fourth video were the same way. Why is Afterthought looking at this garbage?
That I can't speak to, Tom, but I can say that it's popular. We need to do a segment on irony. We're talking about forced sales, technology transfer, tech theft, and we're sitting here in America saying, this is terrible. The Chinese Communist Party have been doing this for decades, and the U.S. administration has been talking about reciprocity. And now they're talking about, you know what, if we can't get access to you, you don't get access to us. And underwriting it all will be national security. That's the direction of travel here, Tom. Well, national champions, and DC's getting behind Microsoft, it seems.
That's certainly the case, and it certainly seems to be bipartisan. But Lisa, what's so important to me is the cash nexus here. With Microsoft, $136 billion in cash, they certainly have the money available to take a dalliance here. Lisa, that really speaks within technology to finally a use of cash.
Yeah, they have the cash. The question is, will they be allowed to spend it both on the U.S. side with President Trump pushing back, unless, let's say, the U.S. gets some sort of kickback from TikTok in order to do this deal.
Key money, not a kickback, key money.
It's an advisor fee, Lisa. It's like being a banker,
all right,
an
so
M&A banker.
The investment banking unit
president
of President Trump.
He's an M&A banker
All
now.
right, but the other issue is you have China pushing back, too. And the phrase of the morning, in my mind, is techno-nationalism, this idea that you're going to get a growing wave of this.
Like
and this move toward, I mean, honestly, with 5G, this sets a precedent, Tom, in order to try to nationalize some of these technological networks after globalizing them in the years leading up to this.
Well, it's a long way from a multilateral approach of 15 and 20 years ago. Futures negative 17, Dow futures negative 117. Yields come in a little bit, not like they were an hour ago, but it certainly has our attention as we go to claims on Thursday, the jobs report on Friday. Right now, a synthesis, and we can do that with Jeffrey Yu of BNY Mellon. He just does wonderful work, yes, in the foreign exchange space, but much wider than that. Jeffrey Yu, let me just start with the conundrum of these low interest rates. Is your attention on the nominal, the current rate, or are you focused on real yields?
Absolutely real yields, because that ties into financial conditions, and that is what central banks don't want to tell you, but what they're actually doing with yield curve control is depressing nominal, get inflation up, get inflation to escape velocity, and depress real yields, because that's the real thing, pardon the pun, which helps corporates.
So, Jeff, that's the objective right now in the United States. You think yield curve control is happening, whether they formalize it and announce it or not?
So, in effect, I think that's what the market's pricing in. And as you say, if the central bank doesn't announce it, but if you keep markets believing for long enough and such that it's effectively priced in, then the central banks in general, not just in the US, but elsewhere in the UK here, I think they'll just clap their hands and say, job well done. It's always about expectations. If they can get longer dated inflation expectations up, then it's a job done. But that's the missing piece of the puzzle right now. Nominal not moving, inflation even less.
Do you think they can, Jeff?
So now this debate about whether they want to start to target average inflation, not just spot inflation, but inflation over a period, I don't think we're there yet. They can, when they start to say, we really want inflation to fly over a 5-year horizon. If your starting point is 1, then for the sake of argument, it doesn't matter that your end point is 4 or 5, as long as you average out to be 2 or 3. You need something like that enshrined in a remit. So the Fed's monetary policy review is coming up. UK, they're reviewing this, all the time. Once that is enshrined, then markets may begin to believe it, but we're not there yet.
Jeff, I want to talk about the reaction function from the Federal Reserve. Monetary policy setting, going to purchase some of these longer dated bonds as the U.S. Treasury announces a near $1 trillion borrowing plan in the next 3 months. Is this basically plunge protection control? Is this basically the Fed that's going to prop up asset prices indefinitely until you get some rip-roaring inflation, which isn't on the horizon, and it's not a matter of any kind of bleed through to the underlying economy at this point?
Well, I don't think any central bank will actively admit that, but they do know if you do get a market sell-off, if you do get bond sell-off, equity selling off, that is a tightening in financial conditions. Now, in reality, the economy, if it's growing fast enough, might be able to withstand that hit, but no central bank, wants to take the chance right now, so they'll just keep going until we get to escape velocity. But the RBA decided, I know they once said, so they're in yield curve control already, as are the Japanese. They might start to say, we're controlling a part of the curve we're comfortable with, but if the very long end, that starts to steepen due to inflation being priced in, they're okay with that. But they have a set target right now, and they're absolutely going to stick to it with asset purchases.
Right now, the real rates on 10-year is a negative 1.05%. What's the breaking point here?
So the breaking point, again, is when there are 2 ways to think about this. One, is it a breaking point to the downside, whereby you fall into a Japan-like scenario where no matter how low you depress real rates, it's just not going to work due to demographics, due to productivity. Then the markets just say, we might as well go home, get out of equities, just stay in cash. There's no difference. Or there's going to be a loss of control, a loss of credibility, upside inflation risk. But I think right now, central banks are more worried about downside disinflation, deflation. That word is still forbidden for them.
Yeah, but to Lisa's brilliant question, Jeff, we're doing yield curve control sort of kind of like, in that you just correctly stated they're worried about disinflation and downside moves. What do you see in the 10-year tips when you see that? I see convexity and some form of gentle acceleration to a Japan-like very low real yield.
Well, that is something that central banks will just have to try to manage as tightly as possible. What is their tolerance threshold? You look at the 5-year break-evens right now; it's falling again. It's below 150. So, do you want to contain that to make sure it doesn't just soar as a sign that central bank is doing that the central banks are being too effective, or do you just want to keep it in a range right now? The trajectory matters. We've gone from effectively 0 in March down to 1.5. They're happy to keep that pace. Even if it goes to 2, they're happy with the pace. But if it suddenly just expands exponentially, then that's the loss of control, loss of credibility we talked about. The risk is always you don't know you've lost control, lost credibility until you actually lose it. And I think that's a risk that all central banks will have to take right now.
Well, Jeff, let's get to what that means in the FX market, the relative story of a currency pair with the US dollar on the one side. How would you push this through G10 right now?
Well, so right now in G10, irrespective of what the RBA said overnight, I'm still very comfortable owning Aussie. Aussie is the best reflation play right now. They've got some China tailwinds in terms of the iron ore market. Property is reflating there, and in terms of trades are improving. Elsewhere, euro, we're comfortable adding to euro longs, even if we get a bit of short-term correction. I am a bit more concerned about the ECB being worried about disinflation due to strong euro, but overall it's more and more clients are asking about the dollar debasement narrative. Are we seeing a shift? Is China going to push for a second win for renminbi internationalization? That, as a structural story, is going to be really, really interesting to see.
Okay,
but
Jeff,
for now, euro and Aussie.
Two stories here. This is really, really important. If someone says to me they like the Aussie, they like the euro, I'm thinking they think we're going to get a pickup in cyclical growth, the return to risk appetite. But when they say we're talking to clients about dollar debasement, there's something else happening there. Which one is it, Jeff?
One is the short-term cyclical uptick of Europe and Australia get their COVID reaction functions right with government investment, and you're seeing that in Europe and Australia. Then that's a cyclical upturn for the dollar story, and it's also a renminbi, a euro, a what is the future for reserve currencies? What is the future for currencies full stop in this new policy paradigm that we have? Then will the dollar's relationships to risk, to cash, to everything else, will that start to change? You've got the 1-year story versus the 10, 20-year story.
Jeff, I can't let you go without nailing you on this. Did you ever think that we'd be talking about the loss of reserve currency status with the dollar index in the 90s?
So it's not about full loss of reserve status, it's loss of dominance. The US dollar will always be a reserve currency, but will it always be 60, 70%, 90%, so dominant in terms of payments, 45% of FX transactions? Those numbers, they plateaued a long time ago. The only direction is probably lower. But is that a 1-year story or a 10-year story? Let's look at the policy mix.
Jeff, fantastic to catch up with you, as always. Jeff Yu of BNY Mellon. Tom Keene, some really important points there on foreign exchange for the short-term cyclical argument and the long-term structural one.
It's a litmus paper of the system. No end if or buts about it. It's the deepest part of the market. Folks, for those of you in America, let me be blunt. John's got this in his blood. It is the foundation of the London, of the city, of all that they do in London. You just have to look at it every day, John. And this tension on dollar, you mentioned the reserve currency status, but this tension right now on dollar is really fun. For us, it's fun. We don't have money at risk.
I miss the city. I've always made that comparison, Tom, that in a cab in London, they'll ask you about foreign exchange. And in a cab in New York, they'll ask you about things like Bitcoin and the latest hot stock, whatever it might be. That's the transatlantic difference.
I miss the city, too.
Do you miss the city?
That little, the room in the back of the Ned there.
That little bar that you like going to?
The little one.
Well, I think I miss the city for different reasons. We know what you get up to in the city. I'm happy to stay here. We've got time. We can talk about it, too.
Oh, we have time right now?
Do you want to do that? I've got about a minute left.
Oh, dear Lord. I would fold in Jeff Yu's excellence in the foreign exchange market into bonds.
Good idea.
Well done.
That's a security, folks, if you've ever seen one. Lisa, I'm sorry, the bonds speak.
I'm in the camp.
Yeah, exactly.
Lisa,
Rescue this.
Lisa, I'm in the camp, Lisa, where it is about bonds speaking right now with a vengeance, and the economists have to follow along.
Yeah, speaking that growth is going to be very, very slow, and people are still buying bonds, even though they are losing money on an inflation-adjusted level over the next 10 years. They are losing 1%.
I don't know, Lisa. I think that's very true, Lisa.
Do you remember that night at the Brexit vote? Do you remember that?
Seriously? We're just going to milk this. We're going to try to make it as awkward as you possibly can for him.
Do you remember that?
It's a blur.
Wasn't for me. Coming up on this program, John Riding of Green Capital. I'm sure you want the answers to that from New York City this morning. Good morning. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. President Trump may take executive action if Congress can't agree on a new coronavirus stimulus package. The president told reporters he might impose a moratorium on evictions and enact a payroll tax holiday. The White House is also exploring whether the president can act on his own to extend enhanced unemployment insurance payments. President Trump insists that if TikTok's U.S. operations are sold, the U.S. government should get a cut, but it's not clear under what authority the president could extract a payout. He said the money would come from China or from an American buyer such as Microsoft. Earlier in the day, the president said TikTok would have to close in the U.S. by September 15th unless an American company buys it. And Hurricane Isaias was downgraded to a tropical storm as it made landfall and moved inland over North Carolina. It's prompted tropical storm warnings all the way to Maine, including Manhattan. Temporary flood barriers and platforms have been deployed in New York City. The storm doesn't pose a threat to any major oil refineries or platforms. And BP has cut its dividend for the first time in a decade. That removes a cornerstone of its investment case after the coronavirus pandemic hammered almost every part of its energy business. BP reported an adjusted net loss of $6.7 billion in the second quarter. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Fiscal policy actions that have been taken thus far have made a critical difference to families, businesses, and communities across the country. And it will take continued support from both monetary and fiscal policy to achieve that.
The Fed really can't stimulate the economy very much when people don't want to borrow and businesses depressed and so on. What they can do is make sure we don't have a financial calamity on top of the real calamity, which they've been doing very well and will continue to do. We need fiscal support.
It also is a very important step in dealing with inequality, ultimately inequality and the institutional biases that are baked into the cake of our economy.
I wouldn't be surprised if we did get the scenario Tom and I were talking about, that the market would just take over and drive interest rates into negative territory even without the support of the Fed.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
We've put ourselves on the front foot again by adapting all the company, by resizing, by adjusting production rates, by adapting the supply chain as well to this new difficult environment.
Europe does, as you say, have some catching up to do on that front. So we are expecting to see a little bit of strength coming through at the start of trade. How long will it last, though? The perennial question.
States should get a very large percentage of that price because we're making it possible. Without us, you know, I use the expression, it's like the landlord and the tenant. And without the lease, the tenant doesn't have the value. Well, we're sort of, in a certain way, the lease. We make it possible to have this great success.
The President of the United States with truly an unprecedented statement as Microsoft continues talks with TikTok to buy its U.S. operations. Absolutely unbelievable the last week. From New York City this morning, good morning. Alongside Tom Keene and Lisa Abramovich, I'm Jonathan Ferro. We're about 1 hour and 12 minutes away from the opening bell. Your equity price action shaping up as follows. Just sort of bouncing along the bottom here, down 13 on the S&P 500, negative 0.4%. Outperforming in the FX market, the Swissy, the Aussie, the Euro. About unchanged, Euro dollar 117.69. And Tom Keene, we've been here for the last couple of hours now. Treasury yields down 2 basis points, 0.54% on a US 10-year.
A new test lower right now, John. We'll see if we go down to a record low 10-year yield. We're not there yet, but we're really right on the cusp of it. There's any number of ways to go on this Microsoft TikTok story. What we're always trying to do, folks, on radio and on television is drive the conversation forward. We can do that at Bloomberg. Sarah Fryer's out with her wonderful book on Instagram, No Filter. There's any number of other social media. But right now, what we wanted to do was dovetail the oddity of Microsoft going after TikTok. Full disclosure, I'm really ignorant on it, and do it with somebody that knows the heart and the soul and the strategic realities of Microsoft. Anurag Rana did this at KeyBank Cleveland for years. He's definitive at Bloomberg Intelligence and joins us this morning. Let me just cut to the chase, Anurag. They're going to buy TikTok. Maybe they will. Is it a dalliance, or do you see a strategic initiative, a strategic priority here?
No, I don't think it's strategic at all. Frankly, it gives them entry into the digital ad market a little bit stronger, but frankly, their bread and butter is, selling software to enterprises. That's the more profitable business. I think they should stick to that.
Anurag, give me the price. I'm trying to understand what a fire sale is and what the price of that would be and what a fair price for this would be. Give me the two prices.
Oh boy, that's going to be tough. Let's hash it out. Okay, so let's say the argument is their revenues, if they are between $500 million to $1 billion, what multiple you put on it? 20 multiple, 30 multiple. I mean, frankly, it could be anything. But yesterday, Microsoft stock went up 5.6%. Their market cap went up by $92 billion yesterday. So that, frankly, with $136 billion in cash and $92 billion in market cap going up yesterday, they could pay whatever they want.
Anurag, is this a sign that Microsoft wants to compete on the content side in a way that Apple tried to do with their offerings and Disney Plus, and sort of more moving to an entertainment aspect that they haven't to the same degree in the past?
No, I frankly think this is just opportunistic here. They're just trying to do the president a favor. Nobody else can buy this thing. Perhaps only private equity out there. They're going to get really good points in the book, maybe get some more defense contracts out of it. This is not from any point in shape, economics at all. It does give them a little more footprint in the $140 billion digital ad market of North America. But, frankly, even coming up $1 billion in sale for Microsoft, $150 billion in revenue, footprint is a drop in the bucket.
Anurag, your world is part of agreements and contracts in this phrase, an arm-length agreement. Do you have any sense of an arm-length distance of TikTok from the Chinese government?
See, I think it's not going to be easy to get this done, just because it's become extremely politically hot right now. Whether this thing takes a different shape after the elections, I think it's possible. But for the president right now, it seems bashing China seems to be the most popular thing.
Anurag, I want to switch gears here off of TikTok. Certainly, folks, that's the news of the moment, into the other social space and the distribution characteristics that you're excellent at. And that can be 5G, anything else, Anurag. What is the theme the media is missing for next year in your world? What's the thing that we're not yapping about right now?
Well, Tom, I can say that in one word: the valuations of these high-tech stocks. They are currently trading way above even internet bubble days. You look at some of these, stocks that really did well post-COVID, they're trading at 40, 50 times forward sales. I'm not saying earnings, sales. And frankly, I don't think many people are talking about it.
So, Anurag, I keep talking about this phrase of the morning. I didn't make it up. I read it, but I thought that it was apt. And it's techno-nationalism, this idea that what we're seeing with TikTok is part of a broader wave to bring technology and keep technology in the United States and not import it from China. What does that mean in terms of the development of 5G and the companies that could benefit more than people perhaps expect in the United States?
I think the biggest piece that we think is going to come out of that is some more regulations around where data is resides for a company. So you could be a global company, but you will not be allowed to transport the data for your citizens outside the country or store it anywhere outside. I think that's the long-term ramification because, that way it kind of protects the citizens and nobody can, hop into that data. As far as 5G and other technologies are concerned, they will be shared over time with different countries. I think it's going to be very difficult to stop the development of those emerging technologies.
Anurag, state capitalism chooses winners. That's what the Chinese have done for a long, long time, and arguably been very successful at it. There has been a narrative, and this feeds into what Lisa is talking about, that Europe, the United States, will start picking national champions, and quite clearly a space where we haven't seen that yet is in 5G. Are we going down the road towards a world, Anurag, where here in the United States, we have an administration, a government, whoever is in the White House, that starts picking a national champion for 5G and starts financing them or at least subsidizing them as well?
To be very honest, I think it's a very slippery slope. It really, I think in the long run, it hurts more American companies than it helps them, largely because they have a very strong foothold in the U.S. and almost any other Western world. The growth driver for them is Asia and other emerging market countries. So if we start to behave like that, I think you're going to get the same counter from them. And those are the markets we really need to be in because those are the ones that are growing. So I think it's going to hurt us more than help us.
We'll see what happens. Anurag, great to catch up with you. Let's continue this conversation for sure. Anurag Rana there, Bloomberg Intelligence analyst. Tom Keene, a conversation that's going absolutely nowhere. And you can see where this is going. And to Anurag's point, this is the direction of travel. And for a lot of people, it's concerning.
I strongly agree, John, that there's a regime shift here in terms of the dialogue. I happened to be in Hong Kong the day the WTO collapsed with a major government official at his desk, and he was in tears over the death of multilateralism. You move forward X number of years, and you're right, John, it's an absolute regime change back to, as Ian Bremmer would say, every nation for themselves.
I've just heard this so many times over the last several years that the world breaks down into two spheres of influence and that we have individual tech champions at the epicenter of those, one driven by China, another driven by the United States. And I think this is a very small story in the sense that we're just talking about TikTok, but it has much bigger implications. Alongside Tom Keene and Lisa Abramovitz, I'm Jonathan Ferro. Coming up on this program, John Riding of Breen Capital, as we count you down to an important week for payrolls data. Payrolls Friday coming up this Friday, and jobless claims coming up this Thursday. The price action shaping up as follows in New York City. Equity futures this morning down 13, just off the lows, off by 0.4%. Treasuries firmer, bid stronger, yields lower by 2 basis points to 0.53%. And euro dollar snooze fest this morning, 117.66. This is Bloomberg.
The decision came pretty quickly over the last 4 months. Once the lockdown happened, we decided we no longer wanted to be in an apartment building and we wanted to have a little bit more room for our family.
I think the pandemic really caused the glue to hold the commitment we had to Manhattan to fall away, because since the banking and the technology companies have said to their people work from home, there's no need for us to be there to service the mass population.
Right.
So if everyone's working from home, we will too.
bars, New York City nightlife, Yankee Stadium, everything about the city. You know, we still love the city, but with the way things are going right now, like I said, I think it's a good move for us and our family.
Some things you see coming, some things you don't. The trick is to be ready for anything. Pablo from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
The volatility in the first two quarters were quite exceptional this year.
Part of it is participating in the better market opportunities that have existed in the second quarter, and we do expect a normalization of that.
The situation out there is still very challenging and very difficult to predict, so we should never be complacent.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
From New York City, this is Bloomberg Surveillance for our audience worldwide, live on Bloomberg TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. The opening bell, 60 minutes away this Tuesday morning. The price action, cross-asset worldwide, shaping up as follows. Equities lower, down 13 on the S&P. We're backing off by about 0.4%. In the FX market, took a sneak peek at 119 last Friday, settled in and around 117 or 117.59 on euro dollar. In the bond market, talked about this all morning. Treasury yields down 2 basis points to 0.53. It feels like a snooze this Tuesday. I get it. It feels like a summer Tuesday. This week is actually pretty big, and the price action, Tom, just doesn't speak to it. The fiscal talks down in Washington. What happens next with big tech? Payrolls data Friday, Thursday. It's important.
It's not a snooze. I'm looking at the Bloomberg terminal, John, and the bond market is screaming at me. This is not a snooze. Only the 2-year hasn't budged this morning. Let's do this. Let's have our conversation of the day on the foundational theories of this economy in this central bank. There is no one across the Atlantic better qualified than John Riding. His original work with Mr. Malpass at Bear Stearns years ago, now at Breen Capital as their chief economic advisor. Mr. Riding is public service to the Bank of England and the Federal Reserve System and is definitive on the underlying theories of the Fed. John, what's the theory of this Fed?
Well, it's clearly shifting to do whatever, and it's a shift that's been in process for a while, to do whatever it can to support the labor market, to support minority and underprivileged groups within the labor market that have suffered higher unemployment rates over the years, and paying less attention and increasingly less attention to price stability. I mean, the good news is inflation is low, but I think the bad news is it puts too much onus on the Fed when, as we know from what happened in the second quarter, fiscal action and timely fiscal action is much more important for stabilizing the real side of the economy.
What is the statistic that you have in your head over how much this stimulus should be right now? I mean, everyone says the Republicans are undershooting at $1 trillion. Maybe the Democrats are at $3 trillion. Do you have a number in your head over the next year where the fiscal stimulus is going? Could it be $5 trillion?
Well, I don't have a number because I don't know how the virus is going to play out, and I don't know how the medical responses, particularly a vaccine and the timing of the vaccine, is going to play out. But we need a fiscal bridge and a monetary bridge across the chasm in economic activity. Now, the economy has rebounded very nicely in May and June, and we'll find out later this week about how July began. But it looks like the pace of improvement has significantly flattened out. And you pointed out earlier in the show about my former center fielder when I was at the New York Fed, Hitman Harris, Ethan Harris. And I agree with him. The number could be 1 million, but we wouldn't be surprised by a negative print in terms of some of the things that we see. So if there's uncertainty about what happened last month, given the data that we have on July, it's impossible to know how the next 6 to 9 months are going to play out. My guess is that by the end of this year, we will still have a substantial amount of unemployment, perhaps an 8-9%, maybe higher unemployment rate. And that's a lot of people who are unemployed through no fault of their own. I think the good news is in the short run, and it's something we've been pointing out, that the income support was such that it more than replaced the lost wage income in total. So there is a savings cushion, and we estimate that savings cushion through the second quarter to be an additional savings of $925 billion. So it's not a shock. It's a problem for many households, but in total, it's not going to be quite the shock that some people's calculations suggest. But I certainly think we need to extend some form of extended unemployment benefits here.
John, forgive me, because these are serious issues, but did you really used to call Ethan Harris Hitman Harris?
I absolutely did. He was a center fielder and cleanup hitter.
Did anyone else?
For the New York. Well, I used to. I coached and managed the New York Fed Research softball team, and Ethan was my center fielder and cleanup hitter, and he got a lot of hits. So yeah, I gave nicknames to everyone in the game write-ups, and Ethan was Hitman Harris.
I love this. Just not a name I would ever give to Ethan Harris of Bank of America. John, let's talk about the new era for central banking. You touched on the price stability mandate. It came out of the 1980s with Mr. Volcker, the obsession with price stability, the war against inflation. Then came the independence into the 90s. And I just wonder what this new era is, John, where this is going and what it looks like, and whether it's the right move to leave behind the work of the last several decades.
I don't think it is. Look, obviously this pandemic is unlike something that we have faced in the last 100 years. I mean, the last time the U.S. faced a pandemic of this magnitude, the Federal Reserve System was 4 years or so old, and we had a very different view of the role of central banks back in those times. So I do understand that the here and now is focusing on the economy, focusing on unemployment, and that's appropriate. But I think that this obsession that we have to raise the inflation rate to 2%, when I can find no serious work that says unless you have a collapse in price level like we had in the Great Depression, running an inflation rate that's 0.5% or so lower on average than 2% is a bad thing, and that we have to elevate the inflation rate. I find that a curious and somewhat misplaced obsession.
And then, John, that goes to the heart of your work over all these decades. Is there any proof that a central bank can, quote unquote, catch up with elevated inflation?
Well, you know, I was chatting to Charles Plusser. Obviously, you know him, a former Federal Reserve
on the show
president.
the other day.
On the show the other day, and I chatted to him after your show. And he made the point, and it's a point that I agree with, that if you haven't been able to hit an inflation target and you keep on saying that that's what you want to accomplish, then you are in danger of undermining your credibility when it perhaps comes to other important things. And I think that's a tremendously important point, because if there's no economic damage being done by an inflation rate of 1.5%, in fact, there may even be economic benefits. I don't know that if you tap a person on the street, socially distanced and wearing masks, and ask them, is the inflation rate too low for you? I don't know many people would say, oh yes, it's too low. I'd like to have the purchasing power of the dollars in my pocket eroded more quickly. And I don't know anyone who would do that. And yet there's this sort of academic view at the Fed that somehow the economy would perform better at a 2% inflation rate over time than at a 1 or 1.5% inflation rate.
Hold on here, because the idea, especially as the United States adds more and more debt, and as companies add more and more debt, the whole theory is that we could inflate away these debt loads, that basically the rate of inflation will make money cheaper so that it'll be easier to pay back this debt. What are the consequences if that doesn't happen? How much do taxes have to go up, especially if we don't see growth pick up at a faster speed than it is now?
But you will not find that theory espoused at the Fed. You will not find people at the Fed who say the reason we want a higher inflation rate is to inflate away the debt, because over time, what do we get? We get the Fisher equation from Irving Fisher. We get higher inflation expectations, and that will push up interest rates. And that's something the Fed would resist. So the Fed would then have to buy more and more debt through QE. And that has the potential to be a dangerous spiral. So, no, the Fed thinks the economy will work better if people believe the inflation rate's going to be 2%. The funny thing is, there are studies that show, and it's a very, very comprehensive study, 26,000 people responded to the study, 40% of them thought that the inflation rate was 10% or higher. The public, in general, don't really understand the nuances of inflation, and certainly not the measurement nuances between a 1 or 1.5% inflation rate and a 2% one.
John, I got time for one more question. We are seeing an unraveling in the real yield. The 10-year tips just hit a new low, negative 1.06. Folks, the 30-year bond, 1.19 handle right now. Do you have in your mind what the Fed does if we get a gamma, we get a convexity, we get an acceleration in the decline of the real yield?
Well, I explained that in a note that we put out on Friday, and it goes back to the Fisher equation, which is the Fed is trying to repress through zero interest rate policy in QE the nominal yield, and it's doing that quite successfully. You report 52 basis points. They're trying to get people to believe in a higher inflation rate, and people are believing in a higher inflation rate, and so inflation expectations are moving up, inflation break-evens are moving up, and the Fed can't repress that. They want that to go higher. So they're left with the real yield, which is the residual, which has to be forced negative. So I don't believe a real yield of negative 1% is somehow truly a growth reading for the outlook for the U.S. over the next 10 years. It is a residual from a combination of interest rate repression on the nominal yield and rising inflation expectations, which is also an active Fed policy desire.
What you just heard there from Mr. Riding is definitive writing, and this is so important, John. Is the real yield the residual of the function, or does it initiate the function? John, that is the arch debate of modern economics.
John Riding of Bring Capital. John, fantastic to catch up with you, Tom. This extends to Irving Fisher's work on wages as well. I remember his work would always talk about nominal wage growth was more important than real wage growth. For people, that's real. What your wages goes up in nominal terms is a much more real experience for you than what it goes up in real terms.
This is so important, folks. And it is seared in the mind of the United Kingdom. When you hear me talk about Clement Attlee deflation, John, this was the collapse of the wage in the United Kingdom in some really, really tough times. That's not envisioned for the United States in 2020, but it is a legacy of fear that's out there that drives policy.
It's not, but I think something else John mentioned as well, Tom, is really important. Just the monopoly that certain ideas have in academia and in central banking right now. And one of them is that higher inflation is good and disinflation is bad. And I think if there's any criticism of the central banks at the moment, Tom, it's just that we don't have alternative opinions. There's a lot of groupthink. And I thought it was really refreshing just to have Charlie Plosser on the program last week, Tom, because you remember the days of the old Fed, just 10 years ago or so, when we had the likes of Richard Fisher and Charlie Plosser giving the alternative view constantly, every single FOMC meeting. I think that's healthy, and it's absent at the moment.
It's very important, but with the force majeure, almost the jump conditions we've got in GDP, aggregate demand, the labor market, et cetera, it's real hard to get a group think. It's everybody for themselves, meeting to meeting.
From New York City this morning, good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Equity futures down 15. We're off by 0.5%. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. President Trump is turning up the heat on congressional negotiators. He says he may take executive action to stop evictions and to enact a payroll tax holiday. Republicans and Democrats say they have made some progress in negotiations on a new stimulus package, but they're still far apart on key issues. China's next target in the growing tensions with the U.S. could be American journalists in Hong Kong. That's according to the editor-in-chief of China's Global Times, who's become known for accurately predicting Beijing's actions. He says that if Chinese journalists are forced to leave the US, China will retaliate against American reporters in Hong Kong. And Argentina moved closer to ending a months-long standoff with investors. It says there's a deal backed by the largest creditor groups to restructure $65 billion of debt. That may open the way for one of the world's most notorious borrowers to climb out of its third default in 2 decades. And here in New York, Facebook has signed a lease for all of the office space at the Farley Building. That's a former post office on Manhattan's west side that's being redeveloped by Bernardo Realty Trust. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
You see coming. Some things you don't. The trick is to be ready for anything. John from Infrastructure Support is working every day to keep essential market data flowing seamlessly. We keep on, so you can keep on.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Welcome to the Best of Bloomberg Technology. I'm Emily Chang.
They've moved the needle by acknowledging that they have to monitor the content.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
True diversification. That's what adding commodities exposure to your stock and bond portfolio can help provide. The Bloomberg Commodity Index is the standard for commodity market exposure. 23 traded commodities are represented: agriculture, livestock, metals, and energy. The Bloomberg Commodity Index is the benchmark most widely used by investment professionals globally. Track your commodity investments with a proven financial information partner. The Bloomberg Commodity Index. True diversification.
The Boston Symphony Orchestra presents BSO at Home, a collection of concerts, at-home lessons, and behind-the-scenes stories to enjoy while you stay at home. Learn more at bso.org/at-home.
We had all this oversupply that had been built up because of the drop in demand earlier this year. And I think it's going to take till middle of 2021 for that excess inventory to be worked off. So you're going to have a very challenging energy industry and oil market probably for the next 6-12 months.
Dallas Fed President there, Robert Kaplan, in the last 24 hours on Bloomberg TV and radio. This is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Coming up on Bloomberg TV in about 12 minutes' time, catching up with Lisa Shannon at Morgan Stanley, Wealth Management CIO. Tom Keene, looking forward to that conversation.
Very interesting and hugely timely given where yields are moving right now, and the huge story this morning and just in the last 20 minutes, folks, with futures at negative 14, is 30-year bond now again under 1.20%, and the 10-year yield directionally towards making history with a new low intraday yield 0.5249% on the 10-year yield. The 2-year yield moments ago just broke down under 0.11. Right now in oil, and we've really ignored this. I've been guilty of this, folks. We need an update. Jason Gamble joins with Jefferies, hugely prescient on the larger dynamics of oil, folding them right into the future of oil. Jason, I've got to start with upstream, and that's always identified with the romance of the British Petroleum Company, BP cutting their dividend today. We saw the Exxon disaster of a few days ago as well. Where is big oil in 36 months?
That's a very good question, Tom. I think that 36 months from now, we're most likely in a much tighter structural oil market. I do think that inventories get worked down over the course of the next year or so, and there's not a lot of investment being made on the supply side. Demand's obviously very tenuous right now, and it would be a big risk to that. But I do think that if conditions return to something more approaching normal,
price here. Let's start with Saudi Arabia. What price do they need right now, and does it dovetail with someone like BP?
Well, just in terms of their production costs, Tom, it's very, very low. Their variable operating costs are only about $3 a barrel, but that doesn't tell the full story. The kingdom needs something more like $65 to $70 to be able to balance their budget. Now, BP is moving towards essentially a break-even price of $35 a barrel. So relative to the governmental overlay, they're actually quite competitive.
Jason, BP cut its dividend for the first time since 2010 significantly. A lot of people own these oil stocks, these oil majors, in order to get the dividend, and yet BP shares are up 6%. Are we entering a new regime where there's something else, another logic behind the purchase of an oil major that has to do, say, with trading revenues, or perhaps their green pledges or something else?
Yes, I think just on the dividend itself, a cut was widely expected by the market, and the stock is yielding 12% on the previous dividend per share. So I do think that the 50% cut was maybe at the better end of what the market was expecting. That could be part of the reason why the stock is doing so well today. It's still yielding 6%. But I think you make the important point about energy transition. And I think one of the actions that BP has taken is actually a strategic rethinking of the company to be more compliant with a low-carbon world. And I think that attracting generalist investors back to the sector is going to require very well-thought-out strategies around energy transition. BP is giving us that.
Sticking with fossil fuels, which oil major is taking the best advantage of the carnage that we're seeing that's ongoing in the shale patch right now?
Well, I would probably start with Chevron. They entered the downturn with the best balance sheet in the sector, and they have moved forward with the acquisition of Noble Energy. That's not just about shale, but Chevron is buying quite a bit of production at a very attractive price because they have the financial capacity to do so.
Do you think that we've seen the worst in the shale patch? The bankruptcies have just been ongoing, and they're heading toward the peaks that we saw a couple of years ago when prices plunged last time. Do we have more ahead in terms of bankruptcies?
Well, I think that the longer that WTI prices stay below $45, the more likely that is to happen. I think that we're probably getting pretty close to a trough in activity levels, bearing in mind that we're down to about 125 rigs running in the Permian right now versus over 400 at the start of the year. But it's still pretty tough right now. There's not a lot of people making money.
Well, okay, I'll go with that. And Jason, you have been just brilliant on the roll-up of the industry. Do you just expect a massive roll-up here because of a dearth of profitability and the flexibility that profitability gives you. It's evaporated, hasn't it? Aren't we going to see one big roll-up?
I think that's probably right, Tom. I'm just not sure that it's going to happen at the corporate level. I think it very well could happen at the asset level instead. And well-capitalized companies could be buying good properties from banking groups that are looking to essentially settle the equity that they've had to take in companies that they really don't want ownership of. But I do think you're correct that this is a business that was in too many hands, and it needs to be run more efficiently.
I mean, what's your single best buy right now? Buy, hold, sell. What do you like best?
I like Chevron best. I think that, again, they're in the strongest financial position within the sector with the balance sheet that they have, and they had a pretty poor quarter in the second quarter. But I think that the cash burn really starts to decelerate.
And probably thanking themselves, they stepped aside on Anadarko. Jason Gamble, thank you so much. Greatly appreciate it with Jeffries this morning. Lisa, as we go into the 9 o'clock hour on radio and television, there's no question the deterioration of yield. Once again, it ebbs down. I did like a 130-day intraday chart, Lisa, on the 10-year yield, and we're right down on a record low Marchish.
Yeah, we're heading there. And what's interesting is that we actually are seeing a better economic backdrop. So how much is this? Full faith in credit, full faith in the Federal Reserve to come in and buy longer dated debt. It was really interesting to me yesterday when Robert Kaplan, the Dallas Fed president, was on Bloomberg Surveillance, Tom, and he was saying they haven't even had to buy that much. All they had to do was signal they would. And my question is, what happens if they're tested on that? What happens if yields go up? How much bigger will their balance sheet have to get? How much are they willing to commit to that? And I think, right now, the market isn't thinking about that. They are just absolutely, they have full faith that the Fed will have their back.
Yeah, I get the Fed, the party politics of it and all that. Lisa, I look at this as just a vote on economy and jobs. And again, does it dovetail into Friday, and does it dovetail into GDP estimates changing in Q3, Q4?
I still don't know if it justifies buying 10-year Treasury yields at 0.5%. I mean, even if you expect the economy to be really, really poor, given how much money has been going in, given where inflation expectations are, do you think that's a good bet, given where real yields are?
There it is. I'm looking at oil with a 40 handle, and folks, a 39 handle would change the discussion. Certainly the 2-year yield is just broken down ever so fractionally, but we'll note that this morning in futures, negative 15. It is a Tuesday. Somehow Lisa Abramowitz and I will be on speaking terms with John Farrow on Friday, because that day really matters. Please stay with us through the morning. I believe there's a TV show following, and on radio, Paul Sweeney and myself will drive the conversation forward. This is Bloomberg. Good morning.
Everything around us, including the way we work and live, has been interrupted. Uninterrupted service is peace of mind. Juzi from customer support is responding to a 500% increase in daily call volume, no matter what. We keep on, so you can keep on.
This is a step in the right direction. Perhaps it's a harbinger for more changes in the future, like the completion of the banking union.
Sense of the real-time action, the 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
From New York City, for our viewers worldwide, good morning, good morning. The countdown to the open starts right now with 30 minutes until the opening bell, with equity futures down 14. We begin with the big issue. The pressure is building, and it shows. Leadership from both parties seem talking up progress.
We are really getting an understanding of each side's position, and we're making some progress on certain issues, moving closer together. There are a lot of issues that are still outstanding, but I think there is a desire to get something done as soon as we can. And so we continue to work. The staffs will be working.
Secretary Mnuchin echoing that sentiment, saying, quote, "We made a little bit of progress. The president wants to get us a deal." Investors keeping the faith something gets done. Policymakers seemingly gripped by mutually assured destruction ahead of November elections. Republican Senator John Cornyn acknowledging the pressure, saying, quote, "I can't see how we can go home and tell people we failed." Joining us from Washington now, Bloomberg's Kevin Cirilli. Kevin, they're talking progress. Are you sensing pressure?
Yes, significant pressure. And in fact, leadership taking a much different tone yesterday, saying that they did have some type of breakthrough, though the specifics of that breakthrough we still don't know. Meanwhile, President Trump saying that he is willing to use executive action in order to bypass Congress on the issue of evictions as well as unemployment benefits should Congress not get to a deal. But it's not just the White House and constituents who are placing pressure on leadership. It's also the business community. Howard Schultz, who is, of course, the chairman of Starbucks Emeritus, and he is saying in a letter that he circulated to leadership with 100 business leaders, quote, "This is not a call for bottomless handouts. It is a defining moment to show how capitalism can benefit all Americans, particularly entrepreneurs who have been forced to shutter or reduce the capacity of their businesses through no fault of their own." In this letter that was signed by the heads of Walmart, Merck, Disney, and other businesses, they're saying that more financial assistance is needed in a next round of stimulus, or else there could be another round of furloughs and layoffs by Labor Day.
Kevin, it's such a strange moment down in Washington when both sides talk about progress but don't tell you what they've made progress on. What do they mean? We have all of these issues. We have liability protection, state aid, enhanced unemployment benefits. When they say progress, what are they talking about? We're getting along with each other, or we've actually made progress?
You know, it's really where the personalities and the politics influence the policy. And really, this has been on a collision course for quite some time. But in terms of the timetable, this really is an inflection point, Jonathan. And based upon the conversations that I've had in the past couple of weeks with sources on both sides of the aisle, no one thought that they would get to a deal by August 1st. However, they did continuously tell me that in the first or second week of August, they would have a breakthrough. I was struck over the weekend as well as yesterday with the president suggesting that he was prepared for a longer fight should they have to bypass Congress. However, following that, the word from Senate Minority Leader Schumer and Speaker Pelosi was that they were having some type of breakthrough. So that would suggest that maybe there's that glimmer of hope that they could get to something by the end of this week or early next.
Nobody wants to face the shame of going home without a deal. Kevin, stay close. Kevin Cirilli down in Washington, D.C. That is the story of the moment for markets worldwide at the moment. A developing story just breaking across the Bloomberg terminal. Let's get that breaking news with Abigail.
John, crossing the tape just moments ago is the fact that Jim Hackett is stepping down as CEO at Ford. Jim Farley, who is the current COO or Chief Operating Officer, will take over as the CEO effective October 1st. Now, the stock has declined roughly 40% since Hackett took the office of CEO about 3 years ago. But today, on this news, the stock earlier had been lower, as you can see, now popping higher, up about 3%. Ford is hosting a conference call starting at 9:20. We may have additional details as the hour progresses, John.
Never a good sign for the departing CEO when the stock climbs on their ouster. The stock up by a little more than 3% on Ford in the pre-market. We'll catch up with Abigail a little bit later on that call, on those headlines ahead of the opening bell. Let's catch up with Morgan Stanley's Lisa Shallett, who says the following on stimulus and the V-shaped recovery. While the deterioration in progress against the pandemic is saddening, we remain convinced the recovery will not be materially altered. Aggressive stimulus, ongoing economic reopening, and healthy household balance sheets should make up for the second quarter's lost output. Lisa joins us now on the phone. Lisa, U.S. resilience, the resiliency of this recovery. You have faith in it, Lisa. Why?
Well, look, I just think it's a question of order of magnitude of how much stimulus we have thrown at this and how much we're probably going to continue to throw at it. I mean, I think one of the things that folks may not fully appreciate is while sentiment, consumer sentiment has begun to stall out and even roll over a little bit, household balance sheets are very, very healthy. Personal savings rates are very, very good. You know, we had record levels of government transfer payments in the second quarter. We saw that in the GDP data. And for the most part, while there was a little bit of translation to consumer spending and some of the retail sales and personal spending data, it's nothing compared to the amount of money that's sitting on the sidelines. And look, if we can, and we do believe that Congress is going to, quote unquote, get it done for political reasons, we're going to keep that buffer for the consumer, and they will be okay. And if the consumer can stay okay against the backdrop where manufacturing and housing and some of those early cycle sectors are really genuinely recovering, and all of the data says it, we should be okay. I think the conundrum for us at Morgan Stanley is that the market doesn't really want to own that story at all, right? That the market wants to own the story that things continue to be horrible and we all have to crowd into, you know, the same 10 tech stocks that we've owned for the past 11 years. And from where we sit, that's the danger in this. There's a lot of cognitive dissonance going on where, you know, we've just had among, you know, the best periods for some of these tech stocks where they've likely pulled forward 2 years worth of demand, and yet people think it can keep going.
Lisa, you've just gone through a long list of anchors to your view that this recovery is sustainable. When you have this conversation with clients, investors, colleagues, how receptive are they to this conversation that you think it is sustainable, and also they should pivot away, rotate away from the winners of not just the last year, but the last several years, and embrace cyclicality?
Yeah, look, there's a huge amount of skepticism. There's fear, there's uncertainty. You know, most of our clients, most of our private wealth, private clients, you know, they sit on Main Street. They live in the real world, and they don't see vim and vigor. They don't see a V-shaped recovery. And so, you know, making this case has not been easy. Certainly, it's much easier for them to buy into the story of I'm staying with what works, which has been, you know, some of the more secular growth-oriented stories. And, oh, by the way, I've made spectacular amounts of money. And, hey, you know, Lisa, you've been suggesting caution for the better of 6 months on those names, and, hey, you've been wrong. So you know, our clients, I think, you know, remain very conservative.
Well, the other thing, Lisa,
tax balances are huge.
As well as people want to stay at home. They want to stay in the United States. They don't want to go abroad. But that pendulum has swung as well in the last month. And the key variable seems to be Europe. Is that your opinion as well, Lisa?
It is. Look, to us, the key variable is the U.S. dollar, right? So you had two things happen. First, you had the EU finally look like they're, quote unquote, getting their act together and going to have some degree of fiscal union. They're going to issue some euro-based bonds, and they're going to work together on fiscal stimulus. That catalyzed a weakening of the dollar, or an acceleration of the weakening of the dollar. And once that going, folks remembered and realized that a weaker dollar is very good for emerging markets because many of those countries are capital hungry and they depend on dollar-denominated debt. So we've had both of those trades kind of working in tandem over the last month or so. And we believe that there's legs in those trades. So we would like to see clients more exposed to developed international like Europe and to emerging markets.
Lisa, not that one data point would change anything for the whole of the team, but I do wonder how you would process a negative print on Friday on the payrolls report if we got one. Right now, median estimate, nowhere near. But if we did get one, Lisa, how would you process that?
Look, the consumer is 70% of the economy, and I think the question is we would have to make an assessment based on the mix in that payroll data, whether it was quote unquote more of the same, meaning that we were seeing the job losses coming in the quote unquote the same old places, which are the consumer facing, the entire consumer facing sides of client service, meaning leisure, hospitality, restaurants, some of those things, versus seeing ongoing deterioration in things like manufacturing, things like healthcare, where we're expecting things to come back, things like education, where we expect things to start coming back. So if we're not getting the validation of that part of our story, we would have to begin to pivot, certainly.
Lisa Challet, always great to catch up with you to challenge the consensus. Lisa of Morgan Stanley. Coming up on this program, Stuart Kaiser, a UBS Equity Derivatives Research Head, weighing in on the new front in the US-China war. That conversation is coming up next. In the markets right now, one stock to look at is the Ford Motor Company. Change of leadership, and the stock likes it, up 3.5% in the pre-market. More to come on that. A media call taking place in around about 10 minutes' time. Abigail Doolittle will guide you through the latest headlines momentarily on this program. Counting it down to the opening bell, 20 minutes away. Equity futures negative 11. We're down a third of 1%. You're watching Bloomberg TV.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
United States should get a very large percentage of that price because we're making it possible. Without us, you know, I use the expression, it's like the landlord and the tenant. And without the lease, the tenant doesn't have the value. Well, we're sort of, in a certain way, the lease. We make it possible to have this great success.
Well, this is an original moment. The President of the United States demanding that TikTok sell its US arm by September 15th and the federal government gets a chunk of the sale. Chinese state media snapping back, saying the following: China will by no means accept the theft, yes, the theft of a Chinese technology company, and it has plenty of ways to respond if the administration carries out its planned smash and grab. Our Bloomberg senior market editor Scarlett Fu joins us now. Hey, Scarlett.
Hi, Jonathan. Yeah, China was very silent yesterday when all this furor was going on, so no surprise that when it did speak, it made pretty clear that TikTok is just the latest front in worsening China-U.S. tensions. I know that I'll be looking for any kind of sign that China is retaliating by perhaps punishing U.S. companies that are operating on the mainland. Now, with regard to what President Trump said about demanding the U.S. gets a cut of whatever deal Microsoft and TikTok's parent ByteDance do come to, he's a property developer by trade, so it sounds like he's thinking of the payment as kind of a finder's fee or key money, although it's not clear in that comparison to a lease, a landlord-tenant relationship, whether the U.S. government is the lease or owns the lease or calls the shot on the lease. None of it is clear, and it's also not clear that he has the authority to do any of this or that it's even legal for him to make this demand. Now, what is clear, John, is why Microsoft would want to buy TikTok. It would help it add a younger user base, expand its social media and consumer businesses, and give its digital ad business a boost. According to Bloomberg Intelligence, a deal's not likely to raise any antitrust concerns because Microsoft is such a small player in this market. It gets about $7 billion annually in revenue, primarily from Bing searches, which is pretty inconsequential when you compare it to the big two. Google gets about $134 billion in digital ads, Facebook $70 billion, and together they control more than half of the digital ad market in North America. Now, Satya Nadella is pretty comfortable making big purchases to expand Microsoft's user base. He was named CEO about 6.5 years ago. He's bought LinkedIn, he's bought GitHub, Mojang, which is basically Minecraft. Bloomberg Intelligence analyst Anna Agrana says that he's done a pretty good job of monetizing these acquisitions as well. TikTok would be probably the biggest deal. We don't know how much it's worth, although I have seen Reuters say the whole thing is valued at about $50 billion. So you take a chunk of that, the North America business, Australia, New Zealand, if that gets in there. Not sure where that ends up, but probably bigger than what we've seen in the past, at least for Microsoft. John?
Scarlett, great work. Thank you. Scarlett will be back on with us a little bit later at the opening bell. Interesting that the Chinese media used this word theft. The US tech CEOs last week were asked a simple question in the hearings. Do you believe the Chinese government steals tech from US companies? Apple, of course, pushed this one to the side and said, we've got no direct experience with this. And then Mark Zuckerberg was very outspoken. He said, I think it's well documented that the Chinese government steals technology from American companies. You can see where this is going. We asked this question to UBS Asset Management's Evan Brown. He weighed in on the tech war with the United States and China.
I think we are definitely seeing the balkanization of internet. This Trump administration action will have effect on global government attitude towards data governance. Actually, a lot of companies will see Trump administration's action on this issue as a signal as their attitude towards data protection.
That clearly wasn't Evan Brown of UBS, but I can promise you our next guest is UBS's Stuart Kaiser, and he joins us right now. Stuart, forgive me for that, and my apologies to Evan Brown as well. Stuart, let's talk about this tension between the United States and China and what it means for big tech in America.
Good morning, Jonathan. Thanks for having me again. I think with the election coming up, this is probably, the shot across the bow in terms of the type of rhetoric we're going to get towards China in the run-up to the election. Our view has been pretty long-standing that this is one of the few bipartisan issues in the U.S. that Democrats, Republicans, and corporate America all agree upon, that perhaps we need to take a stronger stance towards China. So I think this is these headlines are going to persist and perhaps escalate as the election gets nearer. From an investment perspective, obviously with all the tech executives down in Washington last week, this became the new big risk factor to the tech trade that's really led the market for a couple of years now. Whether it's regulatory or valuation, I think people are definitely starting to get a little bit worried about the tremendous outperformance of tech relative to other parts of the market. NASDAQ outperformed Russell by 29.5% in the second quarter. It's the largest quarterly outperformance since the fourth quarter of 2000. So people are certainly very sensitive to anything that might derail that trade. We saw a couple weeks ago a real big pickup in folks hedging their tech exposure coming into earnings. That proved to not really be necessary. It looks like across the board in terms of tech earnings, but certainly people are very, very sensitive to this type of headlines and anything that might kind of trip up the leadership of the market.
Stuart, it's uncomfortable for a lot of people to carry on embracing these massive winners after huge gains so far this year. It's equally as uncomfortable to rotate away from them. Are you just embracing the trade still, Stuart?
I'd say we're embracing it, but with a little bit of caution. I mean, our view has been to own cyclical stocks, but to choose the highest quality cyclical you can find. So you do want to have that exposure to growth, but you don't want to, I don't think, go all in on the laggards at this point. Your previous guest was talking about risks to the economy and the need for stimulus to support that, and I think that debate is sort of ongoing here, and that debate I think focuses on two things: the level of growth versus the rate of change, and then the timing or the sequencing of the growth, because the reported data is strong, but the outlook continues to weaken a bit. So our view is it's not time to go all in on those deep cyclicals yet. You want to remain pretty conservative in how you approach cyclicality. And then from our perspective on the option side, you do want to own some upside via call options in things like emerging markets or China or semiconductors, so that if the trade does run away from you, you do still have some exposure there. And that's, kind of the playbook we saw last year when you had this big kind of momentum or cyclical rotation going on. We didn't see people buying puts to hedge. We saw them buying call options to hedge in the cyclical parts of the market they didn't own. And I would expect that playbook to kind of play itself out again this year.
Stuart, forgive me for doing this, but it just seems that Morgan Stanley's on one side of the trade and you're on the other side of the trade. And if I was identify the reasons why, Morgan Stanley is looking at the improvement and they just think it will continue and persist and that will be sufficient. And Stuart, from reading your research, I know that you're far more interested and focused on the extended period of time below capacity and potential. Why do you think that force wins out?
It's a good question, Jonathan. I don't know that it wins out, but I certainly think it has to change the way you think about risk reward from where we're sitting in the market today. It's stimulus and the vaccine, I think, are the two big positives that you're hanging on to if you want to get into the more cyclical trade. And certainly both of those things, may play out over the next 6 to 12 months. I was a little bit surprised to hear her saying that folks are so negative, with the NASDAQ where it is and with the S&P 500 where it is. I think the market at large is probably pretty bought into the fact that we are going to get an extension of stimulus to some degree, and that we are going to have positive, vaccine outcome by the end of the year. So I think there's actually a fair amount of optimism already priced into that part of the market. What I think is probably underpriced a bit is what if those things, don't happen, and what if the deterioration in consumer sentiment that we're seeing now is a precursor to what the economic data looks like going forward. So our view is you can still generate really good risk reward and really good returns by owning a selective cyclical, and then again having that upside hedge in your book just in case. So I guess we're probably a little more concerned about the level of growth and the deterioration in sentiment, and also how those things are priced relative to one another in the market today.
Stuart, great to catch up with you. Good to see you, mate. So my best to the team. Stuart Kaiser there of UBS. Equity futures just a little bit lower, down 1/3%. The Ford Motor Car Company is higher by around about 3% in the pre-market. Let's get back to Abigail for more. Hey, Abigail.
Hi there, John. Well, certainly big news this morning about 20 minutes ago. Unexpected by many, but the fact that Jim Hackett is stepping down as CEO at Ford. Taking his place will be Jim Farley, the current COO or Chief Operating Officer. That will be effective October 1st. And you can see the stock popping sharply higher, up 3%. Prior to this announcement, it had been down nearly 2%. At one point after the announcement, up more than 4%. So investors clearly like the idea that this company could gain some momentum. Since Hackett took over back in May of 2017, the stock down 40%. So perhaps some hope here that there will be changes. The conference call is starting now. Any details that come out, John, we will bring to you for sure.
Abigail, thank you very much. We'll touch base with you around the opening bell. Coming up before that, up next, the analyst action you need to know. That'll be next in our morning calls. Then later, Jonathan Golub, Credit Suisse Chief US Equity Strategist, on why the dominance of big tech isn't something to be afraid of. Looking forward to catching up with Credit Suisse's Chief US equity strategist from New York City this morning. Good morning to you all on this Tuesday morning with equities heading just a little bit lower. You're watching Bloomberg TV.
It's humbling and it's incredibly exciting in terms of anything that we've done, so far as a company. Florence isn't trying to trick you that she's a real person. Florence is saying, I'm a digital person, I'm here to help. Florence is digital, there is no judgment involved. So the lack of human judgment actually makes our digital people more approachable and potentially more helpful.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Minutes away from the opening bell in New York City this morning. Good morning to you all. Equity futures down 11 on the S&P 500. We're down around about 1/3%. Should we get you some morning calls? Let's get you them. The analyst recommendations on Wall Street this morning. First up, Jefferies raising its price target on AMD to 95 from 86. The analyst saying the chip maker is poised to capture more market share from Intel over the next few years. That stock is up by 0.75% in early trading. Your second call, it comes from the team at Morgan Stanley, downgrading Freeport-McMoRan to equal weight from overweight, but maintaining its price target. The analyst saying revenue growth from new mining operations is priced into the stock at current levels. We're down there by around about 1.5%. And your third and final call, it comes from Susquehanna, the team upgrading Zillow to neutral from negative and raising the price target to 70 from 39. The analyst citing optimism surrounding the improving real estate market. That stock just a little bit firmer, up by 0.7%, going into the cash open. The opening bell is up next. We'll catch up with Jonathan Golub at Credit Suisse, the chief US equity strategist, on big tech dominance. That conversation's still ahead on this Tuesday morning from New York. Good morning from me to you. This is Bloomberg.
As it stands right now, we are seeing too many people for whatever reason, attending work with symptoms. That just cannot continue. Otherwise, these restrictions will be in place for longer than they should be. And I'm sorry to say, we will see more people die.
When community transmission takes place, it is inevitable that it will find its way into the more vulnerable parts of our community, and the aged care community is certainly one of those.
Certainly, these are very challenging numbers. We're at a very challenging stage with this wave. There's probably not a country in the world that has gone through a second wave that hasn't found it particularly challenging. It has very different and complex elements to it that make it quite difficult to manage.
The investment bank merger is something we have been discussing actually for months. This is not a cost exercise. There will be some cost benefits, but it's really about having one underwriting business, to have one investment bank globally, one equities business.
Europe does, as you say, have some catching up to do on that front. So we are expecting to see a little bit of strength coming through at the start of trade. How long will it last, though? The perennial question.
The scores this Tuesday morning shaping up as follows. Equity markets treading water. We are lower by around about 10 points on the S&P, negative 1/3%. We're softer across the board, just a little bit. Switch up the board in the bond market. What a back half of the week we've got. Claims coming Thursday, payrolls coming Friday. There's your opening bell in the Treasury market. Yields come in 3 basis points on 10s to 0.53%. Crude just a little softer, though we're still with a 40 handle at $40.60. We're down 1 percentage point there. And euro dollar took a peek, had a look at 119 on Friday's session. We haven't got back there since. 117.29 right now, down 1/3%. So that's your cross-asset price action this Tuesday. Let's get to the market desk and get some movers. Let's check back in with Abigail.
John, let's start out with one of this morning's big winners, Ford. Shares are popping sharply higher. In fact, right now at session highs, including the pre-market, falling off moments ago, up 4%. But this on the news that Jim Hackett is stepping down as CEO. COO Jim Farley will take over as CEO on October 1st. A media conference call started about 10 minutes ago. I don't see any headlines yet. Something to keep in mind here, they have a ton of debt, 61% debt to asset ratio. We'll be watching the bonds today too. As for this stock, investors like the fact that perhaps a momentum can come in. Back in 1999, this was a $65 stock. Now it's a $7 stock. As for Diageo, the alcohol company, the biggest loser in the stock 600, the ADR here is trading lower, down 3.8%. They put up a fiscal year miss. The outlook is quote unquote murky. It looks like home sales were up, but with bars and restaurants down, really hurting Diageo. As for Take-Two Interactive, not so much, really benefiting from stay-at-home. The gaming company put up a big beat on the bottom line. The top line, a record June quarter, nearly $1 billion in sales, really helped out by Grand Theft Auto and NBA games. And then finally, sticking with gaming, but a different sort, International Game Technology is popping higher. They derive revenue from casinos and also from lottery. You would think that the quarter would be bad, but it was down, John, but they beat. So investors, well, actually right now it's flipping. So we're still assessing that International Gaming Technology quarter.
Abigail, thank you. We'll catch up with you a little bit later. 2 minutes into the session, a mild move lower. No drama. We're down a little more than 1/10% of the S&P 500. Middle of the pack, IT, big tech, not the middle of the pack year to date so far. Absolutely flying. We caught up with Mona Mahajan of Allianz Global Investors, weighing in on the market reaction to tech's blockbuster results.
I do think that that earnings report day on Thursday did partly justify what we've been seeing. These technology names have benefited from a more stay-at-home economy, a more digital economy that relies on their services even more. And so to some extent, the markets were quite astute in calling this early.
On the earnings scorecard, here's Scarlett Fu. Hey, Scarlett.
Hi, Jonathan. Yeah, we're about 2/3 of the way through second quarter earnings season, and here's the verdict as of last night. S&P 500 companies posting double-digit declines on both the top and bottom line, off at least 11% versus last year on average. Now, the majority of companies posted declines as well. Only 1/3 posted any kind of sales gains, 2/5 reported profit gains. But of course, it's all about how you manage expectations, and analyst estimates have come down dramatically. This lowered bar means that 2/3 of companies beat revenue estimates, 85% surpassed EPS estimates. And the margin of beat was fairly narrow on the top line because it's hard to manufacture sales in a difficult quarter, but you can always cost cut your way to preserve profits, which is why 22% beat the bottom line estimates. Now, a couple of themes emerging from the results. April was clearly the worst month when most of the United States was under lockdown. Any kind of outlook was very rare. I saw a statistic that only 20% of companies that usually offer any kind of full year guidance have done so. And no surprise, you're seeing a pickup in M&A as the strong try to increase their market share. The middling tried to buy their way to growth. And of course, the weak are trying to sell themselves out of trouble. Few sectors were spared. Only 4 of the 11 industry groups reported profit growth. Tech and healthcare are the only 2 sectors to post both sales and profit growth from last year. And that tepid EPS growth for technology, up 0.4%, is mainly a reflection of IT services companies dragging the average lower. We're talking about IBM, Visa, and MasterCard. Earnings growth in that sector was driven by AMD and Adobe. And of course, who's left to report? More utilities, media companies, and at the very tail end of earnings season, retailers. John?
Scarlett Fu, thank you. Much more from Scarlett through the market day, right here on Bloomberg TV. What a year it's been already for the NASDAQ 100, up around about 26.5% year to date for 2020. The likes of Microsoft, Apple, Amazon, making up more than 1/3 of the NASDAQ 100. Are the market weightings an issue? Is the concentration a problem? Jonathan Golub at Credit Suisse wrote the following: the current top 5 stocks in the S&P capture a greater percentage of the market's earnings. They're also delivering faster relative growth and trade at a much lower multiple as we compare and contrast the now to back in the year 2000. Let's bring in Jonathan Golub right now. John, no cause for concern is your takeaway. And I have to say, I have to point out, you wrote this before the earnings came out. Are people receptive to this conversation you're having at the moment, John?
They're mixed on this. First of all, they're looking at the data and they're saying you're right, but people are really concerned that 23% of the S&P is in 5 stocks, and over the last 12 months, those 5 stocks returned 58%, and the rest of the market returned 1%. And that makes people uncomfortable, even though when they look at the fundamentals, they say, Jonathan, you are right. These are better companies. They're faster growing, less leverage, less volatility. But the fact that there's only 5 of them with so much dominance does make people feel uncomfortable.
Well, let's talk about history and whether history matters. Historically, does narrow breadth, is that a foundation for a fragile equity market rally, John?
You know, I don't think so. I mean, if you take a look at, on one hand, when you've had breadth that's been this narrow, like you saw in March of, let's say, 2000, bad things happen to the market. The problem is that when you've had those periods in the past, it was speculative behavior in companies without earnings that were really causing the problem. Today, 75% of all of these great earnings, not great earnings, great stock market performance is coming from earnings, not multiples. So this is not about speculative cash flows going into these companies. They're just better companies.
John, we had Morgan Stanley Wealth Management on the program. Lisa Shallett, really respect everything she's got to say. Really interesting research. She's telling clients to embrace cyclicality. What's the other side of the trade, John? What do you say back?
Well, you know, it's interesting because on this, I think I probably take a little bit of a different view on this. What's the downside for this trade is if we get a vaccine, and this is going to sound a little bit strange, but if we get a vaccine and the economy looks like it's really going to take off and cyclical stocks start to really do well with the hope of an economy that's not only beginning to reopening, but that's really going to quickly renormalize, these tech names, they'll do well in that environment, but they're not going to do as well as brick and mortar or industrial companies or materials companies. So in a way, on a relative basis, these are huge winners as a result of the pandemic, not because, just more than anything else, is because those other cyclical companies are just really being hurt, and they're not.
John, just going through the latest research, a final question from me. We've had so many conversations on this show over the last several months, and many people have said to me the most important thing right now is where the 10-year Treasury is. Nominal yield 50 basis points, real yield deeply negative. You're saying it's actually about narrower credit spreads, and I'm just wondering from your perspective why that distinction is important.
Yeah, it's a great point. So, if you think about when the economy is weak, the demand for capital goes down and Treasury yields fall. And we actually look at what the stock market does when on days where the 10-year Treasury or the 2-year Treasury goes down in yield, the market actually goes down on those days, even though people say the opposite. What really is aligned is that when credit spreads, this is concerns about defaults on bonds go down, those are days where people say that default risk is lower, equities are worth more. Usually, they work in opposite directions. So usually, when the economy weakens, the 10-year goes down, but credit spreads widen. That's not happening here. Both the credit spread and the 10-year are moving down together. It's a very, very unusual environment. Follow the credit spreads. They're going to tell you about the health of the economy. Don't get tricked into following the 10-year as your signal.
Hey, John, brilliant to catch up. Hope the team's doing well. Jonathan Golub there of Credit Suisse. In your equity market right now, around about 9 minutes into the session, equities down by about 0.2%. Mild move lower on the NASDAQ, off by around about 1/3%. Let's check back in with Abigail.
John, in line with that mild move lower for the major averages, we have some big laggards. Starting off with the shares of Ralph Lauren, the stock is down sharply after they put up a hugely disappointing quarter. Sales were down 20%. North American revenues really plunged, down 77%. The company is saying that COVID-19 is bringing about quote-unquote new consumer habits. They're going to try to adapt and revamp to avoid bankruptcy of so many other retailers, including Lord & Taylor yesterday. As for AIG, the insurance company, this stock is down about 5%. They posted a $7.9 billion loss driven by the sale of the Fortitude Group Holdings stake. They're divesting old policies for new capital, but today investors not liking that. The big loser, though, on the day, Virgin Galactic, the worst day since March 18th, really plunging. They are delaying a key flight to carry founder Richard Branson to space. They're also planning a $460 million share sale. It seems the new CEO, Mike Moses, who took over recently, not getting a pass. There is, of course, John, a 33% bear short interest on the shares of Virgin Galactic, and it seems those bears are in control this morning with that stock down about 13%.
Abigail, thank you. Thank you very much. 10 minutes into this session, equities down 0.2%. Up next on this program, imagine you're a tech company and you can issue 40-year paper at around about 2.25%. That is what Alphabet has done in the last 24 hours. Up next, Tom Kennedy of JP Morgan Private Bank on this incredible, and I stress incredible, fixed income market. From New York, this is Bloomberg.
Fiscal policy actions that have been taken thus far have made a critical difference to families, businesses, and communities across the country. And it will take continued support from both monetary and fiscal policy to achieve that.
The Fed really can't stimulate the economy very much when people don't want to borrow and business is depressed and so on. What they can do is make sure we don't have a financial calamity on top of the real calamity, which they've been doing very well and will continue to do. We need fiscal support.
It also is a very important step in dealing with inequality. Ultimately, inequality and the institutional biases that are baked into the cake of our economy.
I wouldn't be surprised if we did get the scenario Tom and I were talking about, that the market would just take over and drive interest rates into negative territory, even without the support of the Fed.
The Boston Symphony Orchestra presents BSO at Home. While you stay inside, enjoy a curated collection of archived concerts and behind-the-scenes stories from BSO musicians. BSO Homeschool provides lessons for music lovers of all ages. New performances and messages from musicians are added regularly. Enjoy these selections and much more at bso.org/at-home.
Minutes into the session, equities down 0.2% on the S&P 500. The Nasdaq down 17 points. Call it 18. We're off by 0.16%. That's the equity market 13 minutes into the session. In the last 24 hours, history being made in the corporate bond market. Let's check in with Taylor Riggs. Hey, Taylor.
John, you are right. We know that Alphabet just topped the bond market for the first time in 4 years, selling about $10 billion of debt, of which they had orders of about $38 billion. We're hearing a spread of just 25 basis points over those 5-year treasuries. 7-year portion saw a record low 80 basis points. 40-year debt had a yield of 2.25%. Debt is free, thank you to the Fed. You also mentioned this was a record. Flip up the board, you know, half this deal is going to ESG purposes in what was the largest ever corporate bond sale dedicated to this strategy. Proceeds going to Black entrepreneurs, small businesses affected by COVID, and of course, green energy projects. As you can see, their ESG issuance jumping year over year to $179 billion so far this year, easily a 10-year record. ESG and pretty much every other bond market exploding this year. Finally, what this really means, John, is this comes at a time of really not only a moment of reckoning where companies are facing pressure to invest in ESG strategies, but also when debt is free. Take a look at what is going on just in the general bond market. As you can see, investment grade spread to treasuries in general back to a record low, just 131 basis points to treasuries. Yield to worst, as you can see there, down to just 187 basis points. That is just 1 basis point above a record low, John.
Taylor Riggs, just unreal what's happened in credit this year. Taylor, thank you. Catch Taylor a little bit later around the closing bell together with Caroline Hyde and Romain Bostic. Looking at this corporate bond market through much of 2020 has been absolutely fascinating. Not a surprise that a AA credit like Alphabet can come to the market and do what it's done. Seeing it already in the secondary market, saw it with Amazon earlier this year. What's more interesting over this year is an economy that's been on its knees, volume that has gone through the roof, arguably leverage that has ticked higher, and yet credit spreads have just got tighter, tighter, tighter. Tom Kennedy, JP Morgan Private Bank, weighing in on this. The odd thing is we never had a leverage washout. Leverage is higher now than pre-COVID. It doesn't look like deleveraging is anyone's plan, so this cycle is very different. I'm pleased to say that Tom Kennedy is with us right now. Tom, walk me through this, because this is not what we're used to. When the economy gets bad, the leverage has to be pared down. People have to focus on the debt holders and work for them to get the debt levels down. Is that not going to happen this time around?
Hello again, everybody. Long time I didn't have a chance to speak because there was not many chances to enter the order. Right now, I'm placing an order to sell short Japanese yen at 106.093. So, order placed to sell short at 106.093. Okay?
COVID has accelerated trends in brick and mortar, in technology. It looks like it's also going to accelerate us through this early, and maybe we wake up in 6 months' time, Jonathan, and we're talking about mid-cycle type dynamics. Things are happening a lot faster, and this leverage piece is just one kind of cog in that puzzle.
Tom, what's the Fed's role in this at the moment?
As far as accelerating us to mid-cycle, I'd say that's mostly them. Any way you start to slice the policy initiatives, the size is multiples of anything you and I have ever seen, Jonathan. And then the speed, they brought things to the market with Usain Bolt-like speed. Again, things we've never seen before. And what it has served to do is to keep people in business, keep businesses going, where a financial market shock would have caused them to go default or bankrupt.
Tom, for a lot of people, price discovery is just dead. that the Federal Reserve has ruined this. They're a price-insensitive buyer. They've come in and completely disrupted the credit market. When you speak to people at the moment, are they struggling to embrace the fact that things have changed? Or do they believe that reality at some point will kick back in?
No, I think lots of people are struggling to understand what's happening here, Jonathan. And Taylor hit on one piece. Like, we focus so much on the yield. Record low yields. These are yields I never would have thought I would buy high yield at. Even on your show, Jonathan, I hear that quite a bit.
Yeah.
We need to focus on the spread and the risk component. The Fed's telling us rates are low and they're unlikely to go higher for a good period of time. That should tell us the reach for yield is on. And this Google deal is emblematic, Jonathan, of the current environment. It showcases a couple of things. People want safe assets, and there doesn't seem to be enough of it. So Google's an opportunistic issuer. They came to the market when things look favorable to them. And the fact that, issuance is up this year, but over the last couple of weeks, there hasn't been much to speak of. So getting cash to work's been hard to come to. This deal, Jonathan, came with a negative concession. Negative means Google issued the debt cheaper for them than the debt that was already outstanding. And I know these were small pieces from 4 years ago, but
sure,
nonetheless, this is an important message. And number two, I don't think this really drove the pricing, but it is important, especially for our platform at JP Morgan. Sustainability is real. Corporations and investors want it, and there isn't enough product out there. So Google took advantage of that too. And this is a big piece of our initiative, is trying to build out our sustainability offerings.
Tom, many people struggle with this idea that there are limited safe assets to invest in right now. And the 60-40 portfolio, a lot of people are rethinking now. I've had many people come on this program and